Hi guys, welcome to the financial modeling crash course. And it's good. I mean, it promises to be a very interesting and eye-opening session. And I'd like you to participate, right? I would like us to be very active, right? Everybody to to participate. And if possible, right, um, you can um you can unmute your mic because it's going to be very interactive as well, right? A lot of parts are very interactive. So if possible, if you're in the place where you can talk, please unmute your mic and ensure that you participate to get the most value out of it, right? We'll try our possible best to be done in 2 hours, 30 minutes. I've tried this session multiple times. I realized that 2 hours wasn't cutting it. So you usually end up getting to that 3 hour mark. But I mean, let's hope that we don't get that 3 hour mark, 2 hours, 30 minutes, and we'll be done, right? Um, so before I begin, I'll just like to go around, right? As many people that can speak, right? Just introduce yourself, your name, what you do, and why are you here, right? Or why do you want to learn financial model, or why do you improve your skill in financial model? Maybe does it I mean relate to what you do or anything. So I'll start first. My name is Onyeka, and I work in corporate finance, and I'm working in corporate finance for about 7+ years now. And yeah, I'm the facilitator. And why how I ended up into financial modeling was um well that's what one of the services I was rendering my clients, right? But before then, I actually learned it because of out of curiosity, and it had just grown with me since then. So yeah, that's me. Anybody else? We can take everybody or 5 people, anybody. So please just submit your mic and let us know your name, what you do, and why you are here.
Hi everyone. I guess I can turn on my video. That's fine.
Yay!
But I can. Okay. Yeah. Can you see me?
Yes, I can
Can I
see
see myself? Okay. Hi everyone. My name is Ayolua. Ayolua.
you.
And I work as an accountant data analyst in Berlin.
Mhm.
And why I'm taking this course is, I studied accounting. I'm a chartered accountant. I studied in Covenant University. So I'm taking this course because currently part of my work entails working with our head office and business plan, forecasting, and I'm just like, okay, you know what? I need like maybe a refresher as well as to, upskill. So that's why I'm here. Thank you.
Thank you very much, Ayo. Thank you. And thank you for turning your video on as well. Any other person who wants to go next? Anybody?
I'm happy to go next. My
Okay.
name is Tammy. I'm a grants and impact executive. One of the reasons why I took this course is just to further my knowledge. Happy to be here.
Thank you very much, Timmy. That's my wife, by the way. Any other person?
Hi everyone, my name is Dami. I'm a data analyst and or practicing data analyst basically, and I want to also advance my Excel knowledge, and that's why I'm here.
Thank you, Dami. Anybody? We have 4 people left.
Let me
Tim.
go. Let me go next.
Okay.
Um, Hello, everyone, and thank you, Yinka, for putting this course together. My name is Yinka. Um, I am a growth strategist, working in cross-border payments and experience working in the creator economy. Across my roles, I have to pay attention to a lot of numbers, and I just saw this course and I thought it would be good to upskill my Excel knowledge, potentially to just help myself and on my roles also. I think, thank you so much for putting it together.
Thank you very much, Inka. So we have 3 more people left. Um, any takers? So we can get into the meat of this. Any takers? Or should I just continue and assume that there are no takers, no more takers? Okay, that's fine. Just so we can keep track with our schedule. Anybody taking it? Going. Okay, gone. Yeah. So please, can you confirm you can see my screen? I think I'm sharing my screen, but I'm not sure. I don't
Yeah,
think I'm
you
sharing.
can.
You can. Okay, thank you. Yeah. So now what we'll cover, right, is first I think those that registered on my site, I think some people registered on Eventbrite. Those that registered on my site, I asked a question to kind of gauge your knowledge of Excel, right? Because that would be the basis for financial modeling. To be honest, you don't need to be super person in financial modeling because I mean, it's not person in Excel to know financial modeling. Financial modeling is just a bit of it, right? Just using yeah and there, right? It's more around how do you think about it than the actual doing. I mean, for me, financial modeling is then. Sorry, let me just go to what we'll cover today. Quick Excel warm up. We will do overview of financial modeling, and we will now get into assumption drivers. I believe that's the basis of financial modeling, the assumption drivers. Pretty much how to think about it. Then we'll go into the mechanics of it. That is, we'll go using the case study and actually do one from start to finish. That's why I shared the template. Then we'll wrap it up with Q&A for the last 10 minutes. I mean, to be honest, you can ask questions as you're going along. So you don't have to wait to the end. You can anytime you have a question, just stop me and we'll go. And I would really love a lot of feedback, right? So if you are on your laptop, have the document open and we just go together on it and that to make it, a whole lot of sense. So the first thing is that, can I ask us to open that Excel warm-up? I just want to test our knowledge of Excel and as well because every every formula in that Excel warm-up or everything that Excel warm-up is what we're going to use pretty much, right? So just for us to just get our Excel hands ready. So can we open the Excel warm-up? If you have it open, just let me know you have it open. It should be something like this. I hope you can see my screen. We're using Google Sheets suffice. Yes, it can as well, right? But yeah, it should. Google Sheets will suffice because we're not doing anything. I don't think we're doing anything out of the ordinary. But to be honest, Excel on like MS Excel will be preferable, but Google Sheets can work. So are we ready? Do we have it open? Yes, just confirm yes or no, and I know we are good to go. Anybody? I just need one confirmation. Yes, thank you so much. Yeah, thank you. Right, now, this may look very basic, right? Well, it's basic, right? And we use the next 15 minutes just cover it. But the whole point of this is to get, just to know where everybody is and when we start the financial model proper, um, we know that the basic formulas is not a problem for us, right? So we first start with sum, right? The basic thing, right? Sum in Excel. Sum in Excel is pretty much to add just for context, we have let's assume this is the budget for finance department, admin department, marketing department, right? And we want to do a sum, right? A sum is pretty much alt plus equals to alt and equals to pretty much. That's pretty much what sum is, right? Then you can how we are together. So to do some, there are multiple ways, right? You can do that to equals to this plus this plus this plus you're just adding up, right? Plus this, right? As I said, there are multiple ways you can do it, right? And to copy a formula from left to right. So Excel has in Excel and also in financial modeling, right? Because this warm-up is to get us ready for financial modeling. In financial modeling, on Excel generally, there must be left to right consistency. That means whatever formula you're putting in the left hand or the leftmost area, you should be able to drag it from the left to the right, right? And it will work across board. So I have put a sum function here. If I want to replicate it across board, all I need to do is just to highlight everything and press Ctrl R, and it automatically highlights, right? Is anybody confused about that? It's just basic sum. Just trying to just get us to know what sum is, right? I know it's very basic, but please bear with me. For those of us that are advanced users of Excel or expert users of Excel or intermediate, do you all get? Yes or no? Please, feedback will be very important. So I know that, even though it's one person, I just look one person is getting it, and thank you so much. We can proceed. Yeah. Um, Now the next one is also sum. You can just highlight everything. You can literally highlight everything and press Alt equals to, right? That also works, right? For sum, I just literally highlight everything and press Alt equals to. So that's how sum works, right? I will not go into the rest, but like pretty much that's how sum works, right? And if you want to do a consolidated, consolidated budget, right? So we have the budget for finance, the budget for admin, and the budget for marketing, right? So we have the total budget here. If we want to do a consolidated budget, that means bringing everything together. All we have to do is just call it out, right? So finance. So what the finance budget for the first year equals to finance budget for the first year. That's what we're doing. For marketing equals to marketing, admin, marketing, admin budget for the first year. For marketing equals to marketing budget for the first year. Pretty much that's what we're doing, right? Remember, if you don't understand or if I'm too fast, because I may be skimming through this, right? This first part, because this is just to get us warm up, right? That's pretty much how you call it out, right? Then the second way is you now to I said you might have left to right consistency. So I highlight everything and I press Control R and it copies the formula across board. Do you understand? So it picks all the budget for finance, it picks all the budget for admin, and it picks all the budget for marketing, right? Then to find like a gross total, I can just highlight everything and press Alt equals to, right? And that is that. Is anybody confused about this? This is very basic, but is anybody confused about this? Are we all together?
Yeah. I think this is a new insight for me. The always equals to, because normally I just do equals to sum, da 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 da. But yeah, thanks.
Okay, that's fine. So everybody's good. So let's go to the next one. Mean and max, right? And the reason why this one I'm covering this is just so that because these are all the functions we will use when we begin properly, right? So now for mean and max, it may look very simple, but like I said, most things are simple, but it is when you are using it that you understand, right? Now, for max, what max does is that max gives you the highest value, right? Mean gives you the lowest value. It's as simple as that, as simple as that. But you see when we start using it in practice, right? Max means highest value, mean means lowest value. So assuming we have from our data, we have a set of data. We have 100 blank space 65 and co, right? If I want to get the maximum value of everything, I just equals to max, right? Equals to max. Then you see what Excel is giving me. You see, I see number 1, number 2, number 3. So Excel is telling me equals to what maximum do you want to see, right? So I will now highlight. So instead of using my cursor is misbehaving. I will now highlight everything here. So from 100 to true, right? So Excel will give me the maximum value. And the maximum value you can see is 100, right? I need to expand it. My cursor is misbehaving. Please pardon me to stop sharing my screen and reshare. My cursor is misbehaving. Okay, much better. Can you see my screen now? Sorry. Can you see my screen? That's what they confirm they can see my screen.
Yeah, we can.
Yeah. So the maximum value that Excel will give is 100, right? Because 100 is the highest value. If I change this to 5,000 now, for example, or 500, right? 500 will become what is showing here because it's just giving me the maximum value, pretty much, right? The same thing for minimum value. If I do equals to mean, right? Mean, and I do minimum of everything here, right? What's the minimum of everybody? Just looking at your head, what is the minimum of this? What's the minimum value?
25?
25.
25. That is technically wrong, right? So I'll show you, and that's why we're doing the class, right? So 25 is actually not the minimum value. So can you try it? Just try it and tell me what did it give you? What did it give you? Sorry, somebody's unable to join. Let me send him the link. What did it give you, anybody? Did anybody try it? What did it give you?
25.0.
Give me 25.
25. Oh, okay. Okay, that's fine. Well, yeah, 25 because sorry, pardon me. I was a bit distracted, right? So this one I give us 25 is because when you're doing minimum value, right? Minimum does not take into consideration blank spaces or special characters, right? But there's a second form function called minimum A, right? That's minimum all, right? So this minimum A will return this lowest value from everything, right? For minimum, will return the lowest number. So if I add everything here, including this true, you see that my minimum will return to 1 as opposed to 25. Who can tell me why my minimum is 1 and not 25? Anybody? Does anybody know why it's 1 and not 25?
I would speculate that it's because of the true. True is 1 and false is 0.
Perfect, right? So in Excel, true is 1 and false is 0, right? True is 1, false is 0, right? So for example, if I do 2 plus true, you will see you give me 3, right? Because true is 1, right? Don't forget, Excel sees true as 1 and Excel sees false as 0. Are we all together? Fine, good. Any question? This will be the basis of what we'll do when we are getting to more advanced things. Are we together? Perfect. See a thumbs up. So we go into if, right? Now, all these are very basic, but I just want us to quickly go over it in the next 30 minutes. By 10:30, we'll not begin properly, right? The next thing, because this will form the base of financial modeling, I keep on saying over time, right? The next thing is if statement, right? How to do if functions, right? So for if functions, right? If functions is very big, it's very simple, right? In Excel thinks in this or that. If it's this, give me this. If it's not this, give me this. That's how it is, right? So if generally speaking, is that is black or is white? Is that is male or is female? That's how Excel thinks, right? So for example, assuming we have this set of results, we have these are the people that students, these are their scores, their various scores, right? Um, their various scores in mathematics, right? And we want to say the pass mark is 50, for example. Let's say the pass mark is 50. So if the person gets 50 and above, the person pass. If not, the person fails. That's what we want to do, right? 50 and above, the person pass. 50, I mean, under 50, the person fails. We can use a simple if function for it. Equals to, remember, this is just Excel warm-up. Equals to if, right? If is a function. And you can see that it gives us what we need. Number one, logical test. What do we want to test? We want to test that if the person scored is greater than or equals to 50, the person passed. If it's less than 50, the person failed. That's what we want to do, right? So the logical test is if this scoring mass, right, is greater than or equals to 50, comma, if it's greater than or equal to 50, we won't say the person pass. So we can put pass here. But in Excel, when you want to write in a text in a function in a formula, you must put it in inverted comma, right? Inverted comma. When you want to write in a text in Excel, you must put it in inverted comma. So equals to if the score is greater than or equal to 50, it is passed. Pass. If not, if it did not pass, what did the person do? If I did not pass, the person failed, right? If not, give me fail. Do you understand? Do you understand? Yes or no?
Yeah.
You're perfect, right? Please, if there's anybody that doesn't understand, please feel free to draw us back, right? Now, the last warm up I want us to do, right? Is just get our hands ready because these are all the things we'll use when doing the proper financial model. This just to get our hands ready. The other thing we need to know is growth formula, right? Growth formula, right? And this is pretty much the growth formula. I would like us to all try this first one. This first one, right? You will use this. You will use this as a basis, right? So all you're doing is equals to last year. This is last year multiplied by open bracket 1 plus growth rate. That's what I want us to do. Can we all do it? Can we all do it? Can we just do the growth formula for sales? So assuming your sales last year is 216, But we are saying that in year one, we want it to grow by 6%, in year two by 7%, in year three by 7%. This is how you would do it. Last year sales multiplied by 1 plus growth rate, right? Can we all try it? And can you tell me what your sales in year three will be? If you try it, can we all try it? Can we try it and let me know what your sales in year three will be?
264.6.
Thank you. Anybody getting anything different? 264.6. Do you all know how we got that? Everybody? Are we all comfortable with that? I will do it as well, but I just want everybody to be comfortable with that before I move to the next one. So pretty much it equals to prior year multiplied by open bracket 1 plus the growth rate, right? And I said that it's easy to copy formula from left to right. You highlight everything and press Ctrl R, right? And you get 264.6. Do you all understand? Do you all understand? Yes, no, okay. Okay, thank you. Thank you, Ruth, for confirming. Right. So now let's continue. I'm sorry, I see somebody hands up. Rotimi is okay, yeah. Okay, you're confirming, thumbs up. Okay, that's fine. So now let's go into financial model properly, right? Now the main bane of financial model for me is not actually the mechanics, right? And let me explain what financial model is, right? Before we go into the details, right? Now, financial model in its sense, right? In the sense of it, is a company wants to know, is a company has a strategy, right? So let's take a me and me company. So a company selling these flax. So I have a company selling these flax, right? And the person started the business, is selling and everything, and the company wants to now do a strategy, right, for the business for the next 5 years, right, or 6 years, or 10 years. Typically, 5 years is advised because anything after 5 years is just, especially if it's a typical retail business, right? Anything after 5 years, you're just being fictitious, to be honest, because you don't know what will happen in the next year, but at least 5 years, right? So let's say a company is trying to sell this, right? And say, okay, in the next 5 years, we want to be a market leader. We want every Tom, Dick, and Harry to have this flags. Everybody should have this flags, right? We want to be a market leader, want to be this, want to be that. That's what the company will say. That's what the strategy guys will do. Oh, this is what we want to do. Fine. Then they will not come and say, to achieve this, to achieve this, our strategy, what will the numbers look like? So what will what will our profits be? What will how many of these do you have to sell to become a market leader, right? At what price do you have to sell to become a market leader? How do you have to expand to become a market leader? How many people do you have to hire to become a market leader, right? So that's what financial modeling is. It's translating high-level strategy into numbers, right? Because they can say, I want this, I want this. Everybody can be anything, right? What we do in financial model is you've set all this fine strategy plan for yourself, right? In terms of in terms of dollar and cent, or euro and cent, naira and kobo, what does it mean in terms of figures, actual figures? What does it translate to, right? And is it visible? Because it's very easy to have very nice ideas, very beautiful ideas, but the ideas might not even be practicable. But time you look at the numbers, right? Some people say, oh, in next 5 years, we're making billions of dollars. Congratulations. Okay, we want to make one billion, 1 million. How do you now bring it into sense? That's what financial model is, right? How do you think about it? How do you approach it, right? And there are multiple dimensions to financial model, right? That are varying dimensions to financial model. But um, the pain point of financial model in itself is how to think about it. That's the main point of financial model. How do you go about thinking about it, right? I'm going to share my screen. When you can see my screen, please do let me know. Can you see my screen?
Yes, we can.
Okay, thank you. So now there are multiple dimensions of financial model, right? But what we're focusing on today is three statement model, right? And most of them are not. The three statement model has has most of these other things integrated into it, right? You can have the DCF model integrated into it, the merger model integrated into it. You can have most of them integrated into it, but this forms the basis of every other one. So once you know this, the rest is more. I mean, it depends on if that is your skill area, right? Now I don't go into the mechanics first, right? I want us to think about it. Think about it. So in a financial model, right, you have four major or five major things. You have the assumptions, you have the income statement, the balance sheet, the cash flow, and supporting schedules. The- I mean, in case you're not accounting inclined or brilliant accountant, please just listen, right? The mechanics of it is the least part of it, to be honest. Is how you think about it. And I would like us to go into an exercise. If possible, maybe go to breakout rooms, but maybe we don't have so much time for breakout rooms. We can do it together here. Right? It's about how you think about a problem. How do you think about a problem? And I don't know if you're writing, I want you to write MECE. MECE. MECE, right? So this is a term in consulting. It's called mutually exclusive, collectively exhaustive. Mutually exclusive, collectively exhaustive. Now, this web, whether you're a finance person, data analyst person, working grants, so this is a pattern of thinking. This is how a financial model would think, right? And I think this is more important how you think than what you actually do, right? Because if you can think it properly, to do it, even though, even if you don't know the mechanics of doing it, you can tell ChatGPT, how do you do this thing? It will tell you the formula to use. The formula is now, especially with the use of AI, the formula itself or is not really a big thing, right? It's those that can sit behind the numbers, right, and can think about it. That's where the value is, not in the mechanics of it, right? Once you know the mechanics of it, right, I mean, you can give ChatGPT or give an AI, the AI will do it perfectly. We do it more than you can do it. Do you understand? But the AI cannot think the way you will think, right? Because they don't have all the context. You're the one that have, they have all the context. So, for example, financial modeling is pretty much forecasting for the business. Forecasting for the business. Anybody, how will you forecast a revenue? So imagine somebody. Let's have something basic. Somebody is selling iPhones. How will you forecast the revenue of somebody selling iPhones? Anybody? How will you forecast the revenue of somebody selling iPhones? What or that now? Remember, I said MISI. MISI means collectively. Who knows what MISI is? Like, who knows the explanation of it? Anybody? Rotimi, please go ahead, please. Explain to us. MISI, mutually exclusive, collective exhaustive. Please go ahead and explain to us, please. Yes.
Good morning, everyone. So the concept of MISI is essentially breaking down something in such a way that you are able to account for everything that feeds into it and nothing will be left out. So in the example of forecasting revenue of iPhone sales, a MISI way to approach it will be to think of the volume of sales and the price of an iPhone unit. That way you have all the components of revenue, which is essentially volume and price.
Okay. Thank you very much, Rotimi. Do you understand, right? So pretty much, MISI means that sorry, I'm using what MISI. Mutually exclusive, collectively exhaustive. Pretty much means so the way you get to a MISI, so MISI is a way of thinking. It's literally a way of thinking. Means that when you approach a problem, and this to a way to approach any problem, not just financial model problem. When you're approaching a problem, the first thing you do is that you list out all the variables, all the possible drivers of that problem. Then when you list out all the possible drivers, you now see how can we group it into cadres that will be mutually exclusive. That means one of them, the framework is not overlapping and collectively exhaustive. That means that it caters for every possible scenario. Right. So let's do it in practice. And I would like us to, if you can unmute our mics because this part is very interactive. Because I believe this is the main part, thinking about it than doing it. Now, if we want to forecast the revenue of somebody selling a phone, what information do we need? So you can just be dropping it. What information do we need? What information do we need? That's what I'm asking for. You don't have to listen. You don't have to be correct. You don't have
Quantity
to know
and
it.
price.
Quantity and price. One. What else again do you need? Quantity and price is yeah.
Cost of sales, like
Cost of
the
sales. Okay, yes. So I mean, sorry, please, can you break cost of sales down just to a layman English? Because some people are not fine. I mean, accounting the clients, right? So just break it down.
It's the cost of sales are basically every cost that you incur towards like producing and pushing that goods and service to the point of sale. So like delivery costs, the pricing, cost of production, cost of purchase, basically maybe if depending on your industry, electricity, whatever cost you incur that makes up your cost price, then you're able to, yeah.
Okay, thank you so much. So for this example that we're using our phone, like somebody selling phone, what would be the cost of sales for selling phone? The person sells phones. That's what the person does. What would be the cost of sales for someone that is the person's job is to sell iPhone? That's all, right? What would be the cost of sale? Anybody? Mhm.
Yeah, I think the cost of sale for someone selling iPhone would be more of delivery, and as well, probably if it's importing from wherever he's importing from. So, yeah, delivery and importation, the
So
tax.
perfect. Getting the phone and giving the phone out. That's it, right? So we have said someone said, sorry, I think I will just um pen it down, right? So we can see. Someone said price, someone said quantity, right? Someone said cost of sale. What other thing? So I'm writing it down. So we said price, it said volume of sale, it said cost of sale. What else do we need now? See,
I
honestly,
think location, probably.
location. Explain.
Yeah. So, for someone selling iPhone now, his targeted audience as well might really affect how much it's going to sell, and as well wherever it's located. Well, I mean, in the day of online marketing, so I think that should be. I'm just thinking, anyways. I think
Mhm.
that might also be a driving factor.
Okay. And another person, sorry, wrote to me. I'm going to put the passwords of everything again on the chat. I realized some people are just coming and did not have the passwords, and I've got to share them earlier. So the password is on the chat. Wrote to me. You can just get them. Okay. Sorry. Continue, please. So it said location. I'll put it in asterisks. Okay. What else again? So
Mm,
Just
maybe
to add
like
to,
cost like the rent, depending are you fixing it to fixed and variable cost? So maybe the rent or no?
okay.
Marketing cost.
Marketing cost. So pretty much they're all part of cost of sales, right? So
Yeah.
cost to sell. So the marketing, the cost to sell. Now, remember, what do we want to achieve? We want to calculate the revenue, right? For this phone selling business, right? And what I'm asking you now is, in case you're just joining, what 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 we are thinking through is what are the data points that you will need in order to be able to forecast the revenue, right? So we said you need the price of the phone, right? You need the volume, you need cost of sales, right? You understand the location, right? What else do we need to forecast this revenue? What else? What else do we need to forecast revenue?
The seasonal, the season, the periodic time that probably new models, upgrades, and all that comes out. Trends.
Seasonality, right? So seasonality, that's another one. Yep. Anybody else? Now, what we're doing is that we're just trying to think about it, right? So all these things help you when you're communicating because financial model is not just doing. So if you want to look at revenue now, for example, right? Or we want to I mean attack revenue, what you need is price and you need volume, price and volume, right? Because basically how much phone do you have plus how much will you sell it? That is what you need, price and volume, right? But um that is revenue in its most basic term, right? Then you cannot even go you cannot drill down, right? How do we now factor? I mean, what are the information we need to be able to determine the price, right? Because the way is selling phone, right? What other information? So we said price and volume, which is the basic, right? What information do we need to determine price? What information do we need to determine volume? So how, like, if I say, remember, let's think about it in the sense of somebody doing a business. So the person sells phones, right? Let me not say iPhones. The person sells phones, right? Now you said to forecast revenue, you need volume and you need price. What information do you need in terms of price to forecast the revenue? Or how do you think about price?
In terms of what was the cost price to you as a business,
Yes, so that's one
and
that's one
what
area
margins do you want to make on it?
achieve. Okay, yes, that's one area, but I want us to think in terms of
Demand. Demand.
no. Okay, sorry. Let me go back again. And please, everybody, I would like us to, because this is a like this is the main point of it. Is how you can is those that know financial model knows that one that know how to think about the problem, right? So we have price, right? Let's let's go out of example. I'm selling phones. The, it's not just now. I'm selling phones, right? iPhones. I need volume, I need price. What kind of price do I need? Number one, I need price per different phones. That's what I need. So I'm saying, think about it in terms of what information do you need, right? So I, I don't just need price in, for example, the price of an iPhone 17 or 16 is different from the price of a Samsung or a Techno, right? So I don't just need price. I need price per category. Do you understand?
Yeah.
Do you understand? So I'm not going. So I'm trying to think about it in a segment way. So the first thing when you're thinking about revenue is that always kind of segment revenue into. I mean, think of revenue, price, and volume, but also think about revenue in terms of segments. So, for example, if somebody selling a phone, we think about its segments in terms of different classes of phones. Do you understand? So, price for Techno, price for iPhone, price for this, price for that, volume of iPhone, volume of Techno, volume of this, volume from that. Do you understand? What other segment can we use to segment revenue? So,
But I think you are talking about the mono product earlier. You are not talking about the multiple product. You just iPhone. That's what you mentioned. I think
yeah,
probably.
yeah. So iPhone, but iPhone 16, iPhone 17, iPhone this. Do you understand? There's six segments in iPhone. Do you understand? So let's talk about phone generally. So the person sells phone. Let's not think about iPhone specifically. The person sells phone, right? So we have to think about it in segments. What other segments can we think of? What other way can we think about revenue in segments? So in case I'm looking at my revenue in terms of segments based on the kinds of phones, right? What other way can I think about my revenue? For for somebody that has for somebody that is selling a phone, right? What other way can I think about it apart from segment per per phone type? What other segment can I think about it?
Maybe per season, like someone mentioned.
Okay, okay, sorry. Let's yeah, per season. So can you see my screen?
Yeah.
Yeah. So I have this financial model driver, right? And before I start any project, right? And we'll go through some of them, right? This is what I'll open first, right? Because this is like a logbook. It just shows me everything I need to consider. For example, for me to forecast revenue, all right, I can either do revenue by, I mean, per customer segment. That means I'll say the revenue from those that buy iPhone or revenue from those that buy this thing. So that's customer segment. Or I can say, oh, I want to do revenue by geographical mix. For example, revenue that imagine this person selling phone has different shops. So you can say revenue from shop in China, revenue from shop in London, revenue from shop in Dublin, revenue from shop in Lagos. Do you understand? So it can be geographical mix. It can be by channel mix. So there are different ways you can look at how you can forecast revenue. You can, and no way is more superior to the other way. It just depends on how your business records revenue. Do you understand? So let's use another example. Let me use somebody that does plumbing work, plumbing, right? How would the person segment his revenue? What are the ways the person can segment revenue? The person does plumbing job. How can the person Oh, so let me use something more simple. You might not know what plumbing, the kind of plumbing things are. Or let's say somebody does carpentry, for example, carpentry. Yeah. What are the various ways people can segment the revenue? Anybody? I said there are multiple ways.
I think one way you
By the
can
type
segment
of furniture.
revenue.
Perfect type of furniture. So, I produce chair, table, this. Yeah. What that way? Somebody else. This is the ideation phase. I like us to be very proactive. Anybody else? There are multiple ways. There's not one way, and there's no right answer. Or there's no
I
wrong
think you
answer?
can segment by customer income,
Customer income. Okay. Oh,
like
the man
luxury
can say,
products,
okay,
more
um,
affordable.
okay, because for my premium customers, my standard customers, and my low income customers. Yeah, that's another way. What other way again? Imagine he has the
Maybe
number of
maybe like projects, because if somebody does furniture, the person can also be involved in like roofing
mhm,
and like I mean it's carpentry, no? So you can be
project.
involved in like, roofing, yeah, project. So
But perfect. That also works, right? So say, oh, if how many projects will I get this year? So instead of taking it in the individual thing, like, oh, table, chair, this thing, how many projects will I get? I'll get 10 projects. What will the average cost of the project? I mean, the average price I will charge for the project. This is the average price, and this is my revenue. That's fine. What other way again? Do you understand? Like this how we think about it. What other way? What other way? What other way? Okay, let's let 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 me switch it again. Let's look at on that business. Somebody that's teaches someone like me now that does Excel training and training for people. How will I forecast my revenue for the next 5 years?
okay.
What kind of segment can I use?
Someone that
Number
does
of
what?
participants.
Oh, okay.
Okay, so I can use participants. Okay, how many participants do I want to get this year? I multiply by our average price I'll charge them. Yeah. What else again can I use?
Courses, the kind of courses you get,
Courses. Oh, financial model course. This course. This course. This course. What else?
the frequency.
Yeah, you do on frequency. Yeah. What else? Can you look at this segment? How many training sessions do you have here? Can you look at this segment? Look at channel mix, channel mix. Who can tell me how can I segment it in terms of channel mix?
Maybe your website, Eventbrite, maybe from different socials or something.
Or yeah, or you can say, oh, how many courses should I do online? How many courses should I do in person? Do you understand? So online course, you do 20. In person, 20. Cost for online, price for online course, price for physical. Do you understand? Do you have an understanding of how we are thinking about this thing? Do you understand? Are we together?
Yes, yes.
Okay, there's some people I'm not hearing though. But okay, now let's think about staff costs now. So if now I'm leaving revenue, right? Let's think about staff costs. But I don't want to show the page first because I wrote some things there, right? So let's think about staff costs, right? If I say I want you to forecast what how much you pay in salaries, or pretty much, right? How much you pay in salaries in the next year, what kind of information will you need for us to be able to determine how much you pay in salaries in the next year, 2 years, 3 years? What kind of information do you think we will need? Anybody?
Headcount.
You need what, sorry?
Headcount.
Headcount, that means number of staff, yeah? What else again do you need?
Inflation rate.
Am I hearing, sorry?
Inflation rate,
Why inflation rate?
because inflation affects the cost of goods and services. And there are people have to make adjustments accordingly, and business too cannot be lagging behind, not matching the market pricing in terms of salaries. You have to adjust accordingly.
So inflation rate pretty much means that how much, in case people don't understand, inflation rate means that in terms of salaries you are charging them, right? How will you increase it every year, right? Because obviously inflation is happening. So inflation rate. Someone said minimum wage, yeah. So that means you know that you cannot go beyond, below a particular threshold for a staff. What else again do you need? Do you think we need when
You said
forecasting this?
bonuses and other benefits.
Bonuses and other benefits. We've not said the most important thing actually here. Oh.
Currency.
The salary itself now.
Yeah.
You know,
Salary rate.
you know people, you know how much you are giving them increase, but never know the salary. Yeah,
The basic
How much is
allowance.
currently?
yeah, the actual pay, right? The actual pay, right? Mhm. Yeah. Now, like, is there anything we can consider? Because now, look at it in terms of price and
Promotions?
volume, price
Rate of rate.
perfect promotions. Like for example, if you have certain for example, like you can say this is my number of staff, this is their salary, and add it together, right? But let's say you promote somebody in between the year, that person's salary will increase. Do you understand? But let's say you promote him in July, right? That means for the first 6 months of the year, he's using old salary. Then from July to December, he's using new salary. So you have to factor in promotions, right? What else can you do to factor in? Can we factor in? What else?
Projected new business lines or business growth. If you add
Okay.
in your projection growth.
Please explain to us.
In terms
That's
of
perfect.
if, for example, you have one line of production, for example, and you are planning to increase it to 2 lines in the coming years or coming months. Of course, you have to hire more, and the salary increases as well. Salary cost increases.
Yeah. Do you understand what Salary said? Right. So pretty much your business is growing, right? So if you say, oh, my business will start making let's say you guys were only making 200 phones, but now you want to start making 10,000 phones, right? The business is growing, right? You cannot use the same amount of staff to I will do 200 phones to do 10,000 phones. So you have to employ more staff. Do you understand? So your headcount will increase not because of anything, but because of your business is growing, right? What else can you have to consider? One final thing, just one last thing.
I
Your
would say something like
Mhm.
fiscal policies, like the taxes, the contributions you have to make as an employer. Yeah.
Yeah. Thank you so much. Perfect, right? And I mean, if you're in Nigeria, that's a big deal at the moment. But I mean, one last thing. What's your opposite of promotion? What
Okay, redundancy.
yes, redundancy, right? So redundancy or people leaving the
Turnover.
firm, right? Turnover, right? So come, let's go to payroll, right? So like for example, like if you can see my logbook, you can see the starting account, hiring plan, attrition rates, replacement rates, growth link hiring. That's what Mr. Larry mentioned. Seasonal staffing. For example, let's say you know that like you know that in this, like for example, most of these retail stores they do that thing, seasonal staffing. They know in December they have many, like men will be coming, so they hire a lot of temporary staff in December, right? They are hiring them just in 1 month. So if you look at their head count, you see that January to October is very low, but November and December you see it's very very high. Then drop down again, right? Because that will cause seasonal staffing, right? Then for compensation, we mentioned most of these things: salary, grade structure, annual pay rise, bonus structure, benefits, overtime costs if they have overtime. Then workforce dynamics. Oh, who's going on maternity leave? Who's going on paid leave? Who's going on training? I mean, so training wrap up time. Contractor for the permanent mix. So, for example, these are all these things that you need to consider. So now, as I said, when you do a financial model, you might not consider everything, but if you have this logbook, and I will share this logbook with us make it after this training, is that they can be like almost like a starter guide. What you have, you say, have I considered this? Have I considered this? And this will also help you ask better questions, right? You say, oh, what's your hiring plan? This just like it will help. It will make this boy know what he's doing. Because you're asking better questions, right? This just shows all the drivers, right? And there are many more, but I will not go through everything, right? But like I will share this after the class, right? It just shows all the various drivers that I can consider. Are we together? Are we together? So now let me show us what we're going to do now for the next 1 hour 30 minutes for the actual financial model. Do you understand? Do you understand? Okay. I hope you understand. Nobody. Okay, somebody replied me yes. Okay, perfect. Now that we know how to think about it, right? No, we don't think about it, right? Financial model is in 3 parts. Number one, you understand how to think about it, right? Then you ask the right questions, right? For example, revenue now, like everything we spoke about in revenue, right? Or let's say payroll, right? When we do a financial model or you want to forecast for the business, you will not ask the questions, oh, what's the retirement plan? How many people will retire this year? What's the hiring plan? How many people do you want to hire? What is the growth link hiring? What is the, do you understand? You ask all those questions, right? Then you invert all the data. So that will now forms your assumption, right? So in doing a model, the first thing you do is the assumption, right? And that's what we have tried to understand how to do, right? And remember, it is MISI. So the first thing in MISI, let me just explain MISI again, is that in doing MISI means mutually exclusive, collectively exhaustive. Is that you write out all the variables that can happen, then you segment the variables into different buckets, right? Into different buckets. Like the first thing you first do in MISI is that like what we did. I will write everything. Okay, what should we consider? What should we consider? What should we consider? We have everything. Then we now put it inside different buckets. For example, everything that we have said in payroll, you can see I put in that 3 different buckets: headcount, compensation, workforce dynamics. Everything we have said, I put inside the buckets. Then I will now go out and answer asking questions. Right? Oh, what is this? What is this? Right? So you now have best. So the first thing is that you think about it, all the variables, you put them into different buckets, right? This is what we call a MISI template. You put them into different buckets, then you now begin to ask questions, right? Oh, what is this? What is this? What is this? Right? It's like and sometimes the business may not have even considered it, to be honest, right? We say, oh wow, we never considered that this will impact, because all these things really impact, right? So I have for volume, for price, for revenue, for other drivers, I have for direct costs, for fixed costs, I have everything. I mean, not everything, like majority of the things that you will need is doing a financial model. Once to start, just take this driver and just start using it. I'm going to share this immediately after our class, right? So the first step is the assumptions. The next step is now doing it, right? Putting it on Excel, right? And that's what we want to do now, right? So please, can we all open our financial model blank template, not the completed one, the blank template, right? The blank template. But I'm going to share the completed one. So eventually, this is what we want to get to. This is how we want to get to, right? And our every financial model has four parts, right? Every financial model has 4 parts. The first part they call the first part of the financial model is the input part, right? Input part, which is the assumptions. So we call the assumptions, right? So that's what we have done, assumptions. The second part is the calculation. So just think of assumption as gathering data, all the data point that we need, all the assumptions that we need, right? That I'm making. Remember, this is forecast, right? So we are making educated guess. Not everything will be black and white, right? But we're making educated guess. So we are putting all our assumptions in a sheet, which we call the input sheet, assumption sheet. The next sheet that we will have is the calculation sheet. So calculation sheet is basically what we have done and put in the assumptions. We're not going to calculate it to see what to be. All of our calculation is like when you're doing something in school when we were younger, they'll say show your workings. This is like workings. You're showing your workings. Then the output sheet is actually what they want to see. Like eventually, this is how we affect our 3 statements: income, cash flow, balance sheet, right? Then some people now have dashboard, right? And it is not even a wonderful dashboard. It's just a basic dashboard. A dashboard is almost like because not everybody understands this financial. Nobody understands. Some people don't understand what direct costs. All these things is too much jargons, right? A dashboard is more like an executive summary, right? So this is what you will share to the executive and say, oh, revenue is growing by this. Our ratios that this is just what you use to explain, right? And you can also have in case you want to see some particular ratios, some particular things, you can put it here. So it is like almost like an executive summary. This output is more like a financial summary. Calculation is show your workings. Assumptions is input sheet is assumptions. Do you understand? Do you understand? Yes or no?
Yeah.
Okay, perfect. Now, so that is where we are. That's where we are going to, right? But let's start from the very beginning, right? So the case study that we are working with is that we're working for a watermelon business, right? A watermelon business. So let me share the case study. The case study we're working with. So do you have the blank template opened? Everybody? The blank template open. Because I'd like us to work together. So
Yeah.
this is the case study, right? So they sent to an email, right? Oh, please can you help us? The executive team would like to look at something very quickly, right? You need to create a financial forecast. So they want to know the focus of the business, and they give you very limited information. They say, now they said this one, they don't want to ask too many questions, right? They give you the assumptions already, right? So use these assumptions, right? We don't ask many questions, right? But in real life, you're the one that will actually develop the assumptions yourself, right? But let's just assume that they're giving you some high level assumptions, and they say we don't have any more information. This is all we have, right? What we're giving you, just use it. So what we have, just try and work around it and give us something. Just we don't have any wahala, just give us something. Like help us and do a financial forecast for the next 5 years. We want to know how much we'll be making in the next 5 years. That's the question. Do you understand? So they've given us this, and now we have sorry, this is the complete template. Let me open the blank template. Now, so we have the blank template. Yeah, this is a blank template. Now, they said that they're giving us certain assumptions, right? So we've gone through the assumptions, and I'll be asking us questions, right? As to so I'll ask you, okay, so if they give us the assumptions, what can we do to forecast the revenue, right? That's how we're asking everybody. They give us the assumption, what can we do to forecast what we're looking at? So what they gave us is they gave us their statement. I mean, we are forecasting from 2025. I mean, this is wrong. I should have updated this, but like just assume we're in 2024, right? So yeah. So let's just okay. So let's can we all come here? Can we all come to this dashboard, please? Right? And change it to 2027. Just come to this dashboard, model start, and change to 2027. Can we all do that? Have you all done? Just come here, just change it from 2025 to 2027. Have you all done that? Okay, so I'm not seeing my chat, so let me go and see my chat. Yes. Okay, done. Now let's begin. I don't know what time is. Okay, yeah. So let's begin. So now, what we want to do is understand. So the first thing you do is to understand the assumptions, right? Now remember, this one, we are not the one developing the assumptions. They've given us the assumptions, right? Now, what I want to teach us now is it's a foolproof. Now, what if you're into financial modeling, right? You will notice one of the major issue in financial model is that sometimes your balance sheet will not balance, or like how will I explain this first? Sorry, let me explain the three statements first. The three statements we're looking at: income statement, cash flow, and balance sheet. Now, in an income statement, I don't know if it's clear enough, right? And I'm explaining for those that are not like if you're accounting person, it's fine, but just follow me, right? An income statement, pretty much like I want someone that's not accounting related inclined. What do you think from the name? What do you think an income statement shows? An income statement. What do you think it shows?
How much you made, how much your income was, basically.
Perfect. That's pretty much it. And income is your revenue minus your expense. That's all, right? That's income, right? Now, in your cash flow statement, now I want someone that's not also financial, that's not maybe into finance. What do you think cash flow statement means? Cash flow. Just, I mean, to be honest, there's no right or wrong answer. Like, it's just, I'll just think about it because this will help us in understanding what we're going to do. Cash flow statement. Anybody? That's not accounting related. I know accountant to give us more detailed listen.
I think it's the flow of cash in and out of the business.
Yeah. So, Rema, how is that different from income statement? I mean, just try. How is it? I think it's different from income statement.
I think the income statement shows the income basically. Then the cash flow just like
Shows the
in and
cash.
out, like it's like it just shows the flow because not everything will stay.
Okay, perfect, right? So an income statement is so. For example, right, I sold 50 of this. I don't know this jar that I'm holding. I don't know why I'm holding this things. I sold 50 of this jar, right? And I sold it for $100,000, right? And I the expense I incurred was $60,000, right? So 100,000 minus 60,000, my profit is $40,000. That's what income statement shows. But me and you, we both know that it's not this income, right? There are more things to your business than income, right? For example, some people will not pay cash, right? They'll buy a meal on credit. I'll pay in 30 days. I'll pay in 50 days. I'll pay in 70 days. While it's an income, but it's not cash. You know, that's what you call audio money. It's not. It has not gotten to you yet. is audio money. That means they have bought it. Yes, the goods is not in your hand again, but the money is not in your hand either. Do you understand? So your income statement will tell you that we have made this amount of money, but the cash flow will say what you have in cash is not that amount. To It's only 30 people that have paid you cash. So go and collect your money back. Oh, do you understand? Yes, yes, you have rendered the service. Yes, you have sold the goods, but the money has not yet come. Right? And there are certain other things. For example, like if you bought a new equipment, blah blah blah. That's what factors into the cash flow. Then statement of financial position, right, or balance sheet, right? Who can I mean, you will not be, if you're not financial, I mean, financially inclined, that's fine. But like, what do you think about that? Your balance sheet tries to tell you? Anybody? I want someone that's not listen. Tell me don't try. Rema, who else again that's not finance, that's not really accounting person. What in the balance sheet shows you or tells you? Anybody? Balance sheet or statement of financial position. Let me put it that way. Anybody? Okay, any accountant person, just explain. Or Dami can go ahead. No, Dami, go ahead. Go ahead, please.
Yeah, well, for me, from the term balance sheet,
Yeah, don't worry, try.
so probably, yeah, I'd say what's the transactions that happened um in the fiscal year, basically, and then against what is left in terms of the income, in terms of how the money was spent, basically all the things that has to do with your operations. And then, sorry, I don't know.
No, that's fine. That's fine. To be honest, that's fine. To be honest, that's the whole point of the class that we're all learning. Do you understand? Any accounting person or someone
Yeah,
in finance? Yeah.
know. Okay, so like balance sheet or statement of financial position, to break it in terms, it's basically like showing your net worth, showing you what makes up you, right? Your assets, your liabilities, basically what you're owing, who is owing you, what you've paid in advance, your debts, dividends, like your earnings, and also it also shows you like your equity, what you own or who has bought like stocks with you. So long and short, it's showing you your financial position at a glance, right? This time, everything that makes up you, right?
Okay.
So that's just to simplify it.
Okay. Perfect. So financial position, basically, as she has said, it just shows you your asset and your liability. Asset is what you own. Liability is what you owe. Do you understand? And it's called balance sheet because it must balance themselves. What you what you have and what you own. Do you understand? That was your total assets and total liability and equity, right? That basically it shows. So now let's begin, right? And I said we begin by understanding what we have here. So as I said, this is the assumption they gave us. So they gave us how many days in the year, right? How many months in the year? Okay, that's fine. They gave us inflation rates. That's fine. That means this inflation is high, sha. Maybe it's Nigeria, right? This they gave us inflation rates and they gave us OPEX inflation rates. That means that general inflation rate means that means general things should increase by this amount. OPEX inflation rate means OPEX should increase by this amount. That's what they mean, right? Now, for revenue, right? Remember, these people are selling watermelon. Watermelon. So they said that in year zero, they sold 55,000 watermelon, right? But in 2027, they want to increase that by 7.5. In 2028, they want to increase 2027 amount by 7.8. In 2029, they want to increase the prior year. Thank you. In 2029, they want to increase the prior year um quantity by 8,000. In 2030, they want to increase the prior year by 2050. Do you understand? Do you understand the assumption? Right? So now, if they give you the um I'm sorry. Sorry. They give us the quantity. Sorry. They give us the quantity we want to sell in every year. So in 27, don't sell 7.5, 7.8, 8,000, 8.5, 8.8. So this is what this is the quantity they want to sell, and this is the price. So this is the price as at today. In 2027, they want the price to remain the same because price growth is zero. In 2029, they want the price to increase by 5%, 5%, 5%, 5%. Now, given what you have here, how do you think they want us to model revenue? Anybody? given what the assumption they gave us, how do you think they want us to model revenue? Given the assumptions we have, right? Remember, we don't have all those things that we mentioned, all the location, this, all this, we don't have those ones. This is what they gave us, right? They gave us the price and the price growth and the quantity. How are we going to do it? Anybody want to try?
I would, top of my head, because I'm not really sure what you mean by model, but top of my head would probably be the price times quantity and also factor in the price growth. So,
Perfect. Right? That's how they want us to model it, right? Price times quantity. So they gave us price, right? And price will growing by this percentage every year. And they gave us the quantity by year, right? So to get revenue is price times quantity. So the price multiplied by the quantity multiplied by the growth rate. That's all. Do you understand? Okay, I will take that as a yes.
but
The
sorry, I do have a question.
Go ahead, please.
Because if never mind. So the price is never mind. Sorry, I was mixing up with the quantity that's already incremental. I was gonna say it's not tautology, but I realized there's just one price. Okay.
Yeah. Okay. So the next thing is direct cost, right? And for direct cost, the assumption they give us is direct cost to revenue, right? So that means that, so direct cost means pretty much the cost of production, right? Cost of sale. There are multiple ways, multiple cost of goods sold. There are different ways or different terminologies, right? Although in practice they can mean different things, but generally speaking, they all mean the same thing. So, for example, if I'm selling this phone, right? My direct cost is all the costs I will use. Oh, sorry. If I'm making this plastic, that means it will be a bit easier. If I'm making this plastic, my direct cost is all the costs I will incur to make this plastic, right? So they are saying that the direct cost, the assumption they're giving us is as a percentage of revenue. That means that for direct cost, the way you calculate the direct cost is that your direct cost in year one will be 60% of revenue. So if your revenue is 100, let's say 100 euros, that means you are spending 60 euros to produce the goods. Do you understand? Right? That means 60% of your revenue is cost. That's saying in year two, they're saying 58% of your revenue is cost. In year three, they're saying 57% of your revenue is cost. Who can tell me why do you think that this percentage is decreasing? Who can tell me why they think that the percentage is decreasing from 60, 58, 57? Why do you think is decreasing? Why? I know it's not here and it can be anything, but like who can tell me why they think is decreasing? The cost to revenue is decreasing as the business is growing.
Maybe
Efficiency.
Perfect. Efficiency. Right. So, for example, if remember I said cost to revenue means that for every 60% means that for every 100% you make, 60% is the cost you use to make it, right? But generally, as a business is growing larger and larger and larger, right? As a business is growing larger and larger and larger, they will not be they'll be having some efficiencies. For example, let's say you sell t-shirts, right? You sell printed t-shirts. That means you buy t-shirts, you now print on it and you sell it, right? Initially, when you start, because you cannot buy in bulk, you only buy small, right? Your suppliers will be charging you very high rates because you're buying small amount. But as the price is growing, right? Although you're buying bigger quantity, the price of those things will be reduced because you are buying in bulk. Do you understand? So in essence, you are now becoming more efficient because of scale. Do you understand? I hope you understand. Yeah. So the next thing is salaries, right? And we had a conversation about salaries. Yeah, they gave us average cost per head and number of head. How do we forecast salaries now? They give us average cost of head and average cost per head and head count. How are we going to forecast it? Anybody? Average cost per head and head. Anybody?
Average
maybe
cost, number of it.
Yeah, pretty much simple, right? Simple as that. I will go ahead. I'm just wanting us to just go through over the other assumptions, right? Before we go into the mechanics, we have 10 minutes to go over the assumptions again. Then we have administrative costs, right? They gave us growth rates and they gave us the starting period administrative costs. So if they gave us growth rates and they gave us starting administrative costs, How do you think they want us to forecast it?
Rate multiplied by administrative costs.
Yeah, so just keep on increasing. That is you go through. That means in year one it will not grow, but year two will go by 5%. Year three will go by 5% on last year growth. Do you understand? As pretty much right. So let's quickly run through the other assumptions. Same thing for annual growth rate. I mean, cost of sales. But I'll leave that. The final one. I mean, the last two I would like to talk about is depreciation. Right now, depreciation. Who can explain depreciation to a non-accounting person? Anybody? Depreciation to a non-accounting person.
I can try.
Please go ahead.
In layman English, so depreciation is basically trying to reduce the value in quote of an asset by factoring the fact that you have already used up some life of the asset. So it's trying to reduce it so that it reflects, the current position. Because obviously, when you the way an asset will function when you buy it is not the same way to function in 2 years' time, maybe because of wear and tear or because of couple of maintenance. So it's basically trying to, reduce on paper, on even in reality, on paper to reflect the realistic view of the asset. I don't know how other ways to simplify it.
Okay. Do you understand? Non-accounting people, yes or no? I will say explain it, but do you understand what she said? So let me just use very basic English, right? So let's say you bought a company bought a machine, a big machine, right? Now that machine, they bought because it's a big machine, it cost them a lot of money. So let's say it cost them 1 million euros, 1 million euros, 1 million euros, right? If typically when you want to when you want to record in your income statement, you know it's revenue minus expense, right? Is that 1 million euros an expense? That 1 million euros is it an expense? Anybody that's not accounting, do you think it's an expense? That 1 million euros that's used to buy that big machine for your production or accounting person, do you think it's an expense? Anybody?
It's a constant expenditure.
Yes, it's an expense, right? But now,
Yeah.
so we know the expense. But number two is that is it fair to because that machine will serve you for many years, right? That machine will not just serve you for 1 year, right? It's not just a what you just use and you just do and that is all. That machine you can use it for 10 years, 25 years. Do you understand? So you are going to use it for multiple years. If you if you charge it as an expense in your income statement, it it will you automatically make a loss because you have used that one major cost and just wipe all your revenue, right? But in essence, that machine will last you for 10 years, for 25 years, for 30 years. So what they do is that instead of expressing the full amount in that year you bought it, right? Instead of saying that I spent 1 million on machine, what you will do is that you will not say I spent 1 million on machine, you will say how long would this machine last me for? If the machine will last you for, let's say the machine will last for 10 years and you bought it for 1 million, that means that if what you would do in accounting way, is the accounting sense, is what accounting does is that they'll say every year, I'm spending 100K on equipment. Instead of saying I spent 1 million on equipment, they'll say every year for the next 10 years, I'm spending 100K on equipment. Do you understand? Is it a bit clearer? Because that machine will last us for 10 years, not 1 year. So instead of me using everything inside that 1 year, I will spread it over 10 years and say every year in my income statement, I'll be saying 100K machine, 100K machine, 100K machine, 100K machine for 10 years. Do you understand? Do you understand? Is it a bit clearer? Somebody please answer.
Sorry, can I ask a clarifying question?
Yes, please.
You're saying the capital amount, the 100K, sorry, the 1 million,
1
is not
million.
going to be recognized in the first year, but instead it will be spread over the 10 years.
Perfect. Yes. But we'll recognize that 1 million somewhere else, and I will show you somewhere else, right?
Okay.
But in the income statement, it will not be there. That's why we have three statements. The income statement will because the income statement that's why you see profit or loss. Do you understand? If we put that 1 million there, all our income will disappear. We'll be like, hey, we're not making money, right? But in the machine is meant to last for 10 years. So what we'll do is that we recognize only 100K in our income statement. Then the remaining balance, we put it in our balance sheet. That's what we call balance sheet. The remaining balance, put in our balance sheet. That's pretty much the idea. Do you understand? So every year, our balance sheet will be reducing. So every year, we'll now say our balance sheet give us another 100K. We'll now put it inside the income statement. Our balance sheet now reduce again. The next year, say balance sheet give us 100K. Collect it. Go and put it. Do you understand? Do you understand what I'm trying to say? It's a bit more clearer. Now, so pretty much that's the first step, right? Now, the next step is now to do, sorry, the next assumption is debt assumption, right? So like the business, you can now make money, I mean, to get money, there's a English, not in English, I think there's a saying, they say to make money, you must spend money. Do you understand? To make money, you must spend money, right? So if the business wants to do anything, they must spend money to make money. Do you understand? Like you must buy equipment to produce and not sell. Do you understand? You must hire staff to do your service before you. So to get money, you must spend money, right? So how do a business get money? Get money to spend initially when they must start selling. They get it either by loan, they get debt, they borrow me money, let me do my business, or they get it by equity. Equity means that the owner of the business will drop his own money and use it in the initial stage for the business to run, right? Then later they cannot pay back the owner the money. So if the owner is dropping the money, what you call equity. If it's borrowing, what you call debt. So that's how a company generates money initially to run the business or to expand, equity or debt, right? And that's all I will explain at the moment in the assumption, right? So we get money by equity. So yeah, we say that the we want to we get money by equity or debt. And yeah, they say that we want to borrow 80% and we will. So that means if the business will cost us 1 million, right? 20% will come from the owner's pocket, 80% will come from debt. That's all this is saying. Capital structure. That means the business we need 1 million to start this business. So okay, don't worry. 20% is from me. 80% go and borrow from the bank. I don't have the money. Go and borrow from the bank. 20% is my own money. Do you understand? That's as simple as that, right? Now, for those of us that have been doing financial model very often, right? I would like you to please listen very, very carefully because from now on, this is where you really, 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 really do need to listen to, right? So one of the issues is that most times when you do everything, your balance sheet will not balance. And I said, but financial model is a science and is a art. An art because you can use any method. That means like the assumptions we're doing now is an art, right? What we're talking about the drivers. Somebody can forecast revenue using geographical channels. Another person can forecast revenue using segments. Like if you can remember when we're talking about the iPhone, the phone seller, you can say, oh, you can do revenue from iPhone, different types of phone, or you can use it from different kinds of stores. Or you can say, oh, revenue that I got from online sales or from on-site sales. You can use multiple ways, right? So financial model is a art in that sense because it's up to the modeler to determine how it will go. But it's also a science because there are certain processes that you must follow, certain steps, right? And what happens that if you try and use you try and use art to do it, like just try to do it on vibes, right? Your model will always no balance. And the thing is that I don't know for those that have been doing financial model for a while, let's say you've done everything, and maybe you just say that it's not balancing. Maybe it's 50,000. Like you just want one useless money. You're not be looking for it everywhere. And to find to balance to make a model balance is harder than ensure that everything is than any other thing because you don't even know where the issue is. You'll be checking everywhere. Where is it? Everywhere. Where is it? Where is it? Where is it? Where is it? And you can spend 2 hours, 3 hours, 1 day, 2 days. I remember there's one model I was working on. I spent, but let me show you the model. Can you see my screen? Uh, I've changed the company name so you will not know. Sorry, trying to share this. Sorry, means I want to share this particular model, right? But obviously, there are very complicated, more complications, right? So, like, I was working on this model, right? And you you see that it's a bit different. Like the dev schedule is very large, we did month and stuff, right? I'm working on this thing, and it took me almost 2 weeks to find. I've done everything well. I've done everything. It took me 2 weeks. 2 weeks. I finished my model. But to make it balance, it took me 2 weeks because I don't know what the issue was. I was checking. So after I experienced this heartbreak, right, I now developed a model, a pattern to balancing the model. So if we use what I'm going to teach you now, your model will always balance. Your model can be wrong, but will balance. I mean, what I mean wrong, that means it might not make sense. That means maybe your revenue is very high or something, and that's because of your assumption. But will it balance? It will always balance. So please follow me carefully. So the first thing I said we'll do is to understand the inputs. The next thing is calculation, right? So calculation sheet. Now, this is where our um Excel warm-up will come into play, right? So the first thing is price and quantity. Let's start with quantity first, right? Quantity. What's the quantity? Let's go to the input sheet. These are the quantity, right? 7,000, 58, 8,000, 85, 88, right? What we'll do is we will just bring the quantity here equals to the quantity. Enter, right? And we bring everything here. What we just did that we just brought the quantity here. Do you understand? Is it very clear? Is it very clear? Yes, right? So now the next thing is price. Right? Now, the best financial model are the ones that are very simple. When you see a financial model like the one I did here, let me show you, right? The one I did here, right? Let me show you the formula, right? Can I see the formula here? No, let me show you this one math formula I did somewhere. Right? Every time you say a formula that is too complicated, right? The person is most likely doing rubbish. Like every time it's like, I mean, it's good, but it's good to have all these multi formulas, different things, right? But a good financial model is very simple, right? I've worked on multiple. I've worked on financial model for 20 years for companies, for governments, right? What really makes a financial model is the simplicity. That yes, you don't try and lump too many things together. Just use one by one. Like there are ways that I could have done this thing with one click and it will be done, but it makes it very hard to now trace the error. But if we do something like this, it's easy to trace the error. Say, okay, this is where I made the error. It's easier to trace it. The next one is price. Now, what do you have for price? We have price. We have our constant price and we have our growth rate, right? What are we going to do? How are we going to calculate the growth rate? It's pretty much is the price, this price, right? Multiplied by 1 plus this growth rate. That's our price. Do you understand? Do you understand? Hey, I don't want to lose anybody. Do you understand?
Yeah.
Okay, understand. Right. So it's pretty much. So now that we have done the first one, right? But the next of us will now drag it forward, right? So now if we now drag it forward, we have zero. Why we having zero everywhere? Zero everywhere. Zero everywhere. Zero everywhere. Zero everywhere. Why we having zero everywhere and not the increase? Why?
I think because we dragged it, so it's for the 55 now. In the next column, it's 0, so it's moving 0, 0, 0. So 0 times whatever is 0.
Okay. So we are having issues with it, right? So now let's go back to our input, right? I understand what they're saying. So isn't that once you can understand the input, like to do the calculation is very simple. So what are they saying here? They're saying that this is a static price, right? But in year one, we want it to increase by 0%. That means year one, the price is not increasing. But by year two, we want it to increase by 5% of year one price. Do you understand? Right? Do you understand? Hey, I don't lose anybody, please. Do you understand?
Yeah.
Then in year three, what do you want to do? Can somebody explain in English? Just in English. In year three price, what should year three price be?
Year 2 price times 1 plus the growth rate.
Yeah. Somebody else, what should year four price be? It may look very big, but please just follow me. What should year four price be? Or what are we going for year four?
Year 3 price times 1 plus the price growth rate.
Okay, so let's go to calculation now, right? So what we want is that for every year, we want the previous price. Sorry, let me do for year two first. For year two, what we want is year one price multiplied by 1 plus year 2 growth rate, right? This is what we want, Abi, right? Do you understand? Are we together? Right?
Yeah.
Yeah. So that we want, and we bring it up here, right? But the issue is that with year one price, we don't know what year one price is. Year one price is this 55,000, right? So if we bring this 55,000 to year one, right? Year one, right? If you calculate, right? And this is correct. But Excel, I mean, speaking as an Excel person, this is wrong. It's correct. The numbers are correct, but the technique is wrong, right? And what I'll teach you guys is how to do proper technique. And one of the rules of financial model is that please, you can put it anywhere. You must have left to right consistency. Left to right consistency. That means that any formula you are starting with here, left, must be the same formula you use everywhere. So what you're using what the formula you're using in the first column, you will be able to drag it across. But now, what we're using here is different from the one we're using here. These four are the same, but this first one is different. So what we need to do is to make sure that it is watertight. So I will show you, right, the way to make watertight. And what to make watertight, what you is what we call using a flag, right, or an anchor. So pretty much what in English term, what we want to achieve is that year one price should remain the same. If it's year one, give me the same price. But if it's year two, then give me the formula. That's what I want to do. Year one, give me the same price. Then if it's not year one, give me the formula. Who can remember what we did in the Excel warm-up? In the Excel warm-up, that if. Can you remember if? If. So I said, if it's this, give me this. If not, give me this. That's what I'm going to use to apply here. So we'll tell Excel, right? Excel, if this year is equal to 1, that means if it's year 1, right? If it's equal to 1, give me 55,000. If not, give me prior year, right? Or give me 1 plus prior year multiplied by growth rate. That formula we're talking about, right? So pretty much we are telling Excel, my cursor is misbehaving. I can't find it. Times year one growth rate, right? Brackets, close brackets. 1 plus this. Do you understand? Do you understand? Oh, sorry, my cursor is misbehaving. Guys, do you understand? Or are we confused? The silence is making me look like you guys are confused.
I understand.
Okay, so who is that? Sorry, let me see. Who understand? Who says you understand?
I
Ayolowa. Who else understands?
I understand the formula, but I'm wondering why make it like why use the if statement? Why anchor it that way as opposed to the original calculation?
So the reason why we're using the original calculation is that the original calculation will only work for year 2 to year 5. For year 1, we have to use something different, right? But Excel, we need to have what do you call it again? A constant formula that we can use from left to right. So the formula is, if this is year 1, give me the input, give me that 55,000. If not, give me prior year price multiplied by the growth rate. That's what I asked you to do. Then I can copy it around. And you can say it's still the same value. It's still the same value, but the formula is better, right? Now, people can do it in different ways, but me personally, I prefer left to right consistency. Right? And in case you understand, don't worry, I'm trying, okay. Please, you can also try it out as we're doing it. So we'll not just be only me doing it, right? Now, how do you not calculate revenue? Revenue is price times quantity. So this is equals to price multiplied by quantity, right? Then we can now drag it left. So this is our revenue. Do you understand? So we've got our price, got our revenue. Our revenue is now our revenue is now price times quantity, and that gives us what we have there. Is that clear enough? Okay, I believe so. The next one is direct cost. Direct cost. What they gave us is a percentage of revenue, right? So what we do in our calculation is the first thing is that what's that percentage? We'll come here and we'll link it to the percentage. Percentage is the input sheet. Year one is 60%. Year two is we just copy everything, right? So year one to year two, this is the percentage, right? Next one is what our revenue. Our revenue is what we have up here already, right? So we link it and we copy it here, right? So our direct cost will now be the proportion of revenue. That will be equals to 60% multiplied by this one, right? So this is our direct cost, and we highlight everything and press Ctrl R, and it copies it. I mean, pretty much we do it for all the years. Do you understand? Do you understand? Do you understand? Anybody confused or anybody, or are we all together?
Yeah.
I'm sensing some resistance. Are we together? I've learned from some people in the world. Yinka, Rem, I can't remember. Peace just came. Welcome, Deborah. I've learned from you. Lion, Rem, learned from you. Are we all together? Are we doing it together, or are you
Yes.
just watching? Okay,
We
thank
are
you.
watching. We are watching it together.
Okay. um.
Yeah, trying it out as well from this end.
Okay. Yeah. It will help if you try it out because sometimes you can listen to something. I know how to do it. I know how to do it. Then you're not gonna do it. You now say, hey, I don't understand this thing. No. Yes, and I will just go back to the price formula one last time. Or do you know what I will do for the price formula? I'm going to use that same method again, further downward, and I will explain that. Is that fine route, right? I'm going to use that same logic in another few minutes. So I will explain it that, right? So the next one is salaries, right? What was our assumption for salaries? Can somebody explain our assumption for salaries? What they give us for salaries? Can somebody explain that
Head cost per
the assumption,
head,
the input
head count and price per head.
and price per head, right? So the head count will be equals to, we'll just link the head count. For the same reason, my cursor is misbehaving. So we link the, why is this misbehaving? Sorry. I think I need to stop sharing my screen and reshare again. I don't know why it's misbehaving. Okay, sorry, let me just take it off. I'll put it back in again. Sorry. I think it's worked now. So I'll share my screen a bit. When you can see my screen, please let me know. Can you see my screen?
Yeah.
Yeah, my cursor is back. So now, for the salaries, right? What will give us for the head count and average cost per head, right? So head count is this, right? We have the head count already. 6 employees, 8, 9, blah 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 blah, and we copy it here, right? The next thing is the cost per head. Cost per head, we have it here, right? We have it as 6 million per head, right? For year one, right? Now, should we retain? Do you think that the cost per head will remain the same every year? Do you think the cost per head will remain the same every year? Anybody?
I don't think so.
It shouldn't.
It shouldn't, right? So now, I said, now this now, so we in our head, using our own mentality, we believe that it should increase, right? So we can say because I mean nobody wants any the same salary every year for 5 years. You resign, you will leave, you will not stay there, right? So what we can do is we can increase this by our inflation. We have oh shoot my yeah, we have certain rates. We have, if you check up here, we have inflation rate and general OPEX rate, right? So we can increase it by inflation rate. That means your salary by the average salary will increase by 11% in 2022, by 10%. Like we can increase it by that because realistically it should not remain the same, right? So what will come here is that our price for year one will be the price, right? So this will be roots. This where this root and root to me, this way I want to explain that same thing again as well. I did in price, right? So we are saying that in year one, right? In year one, we want our price to be 6 million, right? It will not increase in year one. It's pretty much the same thing, right? But from year two, year three, year four, we want it to be increasing, right? Do you understand? Are we together? I'm just
Yeah.
explaining this calculation thing again, right? So that means that it equals to if is year one, right? If this is equals to one, that is year one, right? Just give me my 6 million like that. So Excel, I say Excel, if it's year one, my cursor is remain in one place. Where's my cursor? Sorry, let me find my cursor first. Sorry, my cursor has disappeared. Is I think it's having just holiday. Okay, yeah. So is it back? Sorry, I'm for some strange reason today my cursor is just having time of his life. So equals to if where's the cursor? If this is equals to one, right? That's if it's a one, right? What I want you to do is to give me this 6 million. Give me 6 million, right? This 6 million, and I will lock it, right? So if it's year one, so every time it's year one, give me the 6 million. If not, what I want to do is that I want you to give me the prior year average cost and multiply it by 1 plus the growth rate by inflation rate, 1 plus inflation rate, right? Which is yeah, right. And I close it. Do you understand? So that means for year one, you give me 6 million, right? Because it's year one. But every other year, what it will do is that it will do for year two, it will do 6 million times the inflation rate of year two. For year three, it will do year three's amount times inflation rate. Do you understand? Is it a bit clear?
Yeah.
Okay. Okay. I will just assume that it's clear. So now the next one is um um adm- administrative costs, right? So let's check here. So the administrative costs, they gave us the percentage growth, right? 0.555, right? So I'm doing the same thing, but in a different way. So administrative cost for year one, we have it here. Just come here. That's zero, and this, right? So this is our administrative cost, right? Now, what is so we know how to calculate our administrative cost. For year one, our administrative cost is this 7.5 million, right? That's for year zero, right? But what will do that for year one, it will increase by 0%, but year two, it will increase by 5%, for year three, it will increase by 5%, for year four by 5%, for year six by 5%. What we'll do is equals to prior year multiplied by one plus growth rate. That's what we're doing, pretty much. So that means in year one, what we're doing is the year one growth rate is zero, right? Because we're not increasing it, right? So it is prior year multiplied by growth rate. And if you now drag it across, you can say what this is doing year one multiplied by the growth rate 5%. Year three is now year two's amount multiplied by the growth rate. Year three's amount multiplied by the growth rate. Do you understand? Do you understand? Are we together? Somebody please reply me. Eh? Please, if you can mute your mic, so I know that we are together, right? And I don't lose anybody. So now I've done this one. Can somebody can we all try our hands on is this one and this one are the same thing? Can we all try our hand on other costs, right? And tell me what other costs will be in year five. Can we all try it? Can we all try it? I'll give us 3 minutes to try it. It's literally the same thing as administrative costs. Can we all try it? Even though you're not be following it, I mean following, you don't have to do everything. Just do this other cost. I want to know that we're all in the same page, in the same boat. Sorry. And just tell me what your year five other costs will be. Any takers?
A quick question. So the other cost rates, it's the same as the administrative growth rate, right?
No, the other cost rates, if you check up in the beginning, you see, well, you can use okay, let's use the same thing. So we'll be in the same place. Let's all use the one sorry, let's use the one in the OPEX inflation rate. OPEX inflation rate. So let's OPEX inflation rate here as the growth rate. Let's use OPEX inflation rate as a growth rate. So we're all in the same page. OPEX inflation rate from the everything. Can we all try, please? I would like us to get what year 5 will be, please. Can somebody just get it for me? Anybody? We're almost done our calculation. And make it done the calculation. We're literally almost done. Can somebody get it for us, please?
Is it 2,431,013?
Yep. Who has got that amount? Right? I mean, I will just go ahead for want of time. But it's 2 million, as Rotimi said, 2 million. I think my screen went off. 2,113,000. But let me share my screen and we do it together. Right. So I said it's very basic, it's very simple. What we do is we first copy the growth rate. The growth rate we said is OPEX growth rate to come up here. For year 1, OPEX growth rate is here, this, right? And we copy everything across, right? This is very basic. Then our starting point, starting OPEX, starting other cost is here, other cost is here. Our starting other cost is this 2 million here, right? And what we are doing is last year multiply by open bracket 1 plus the growth rate of this year. That we are doing, and we copy, we highlight everything and press Ctrl R, right? And copies it and give us 2,431,013. Who else got this same thing? Papa wrote to me. Anybody else got it? Yeah. That Dami, what about you? Rema, what about you? Tim, what about you? Yinka, what about you? Do you also get the same thing? Adenike, what about you? Ruth, okay,
Yes, I
Ruthie.
did.
Okay. So yeah, we all got the same thing, right? So now the next bit we'll look at is depreciation, right? We will leave these two, this taxation and dividend, right? We leave these two, but we just go to depreciation, right? Now depreciation, right? So now when you're doing a schedule, and if you can pen it down, please pen it down, right? When you're doing a schedule, right? A schedule in and what of that after this call, I'm going to send you um the formula drivers sheets. I'm going to send you this notes, this input sheet, how to balance this thing, and we're also going to share you key points on modeling as well, right? So when you're doing a model and you're doing a schedule, right? A schedule is, I mean, for depreciation. Remember, I said depreciation is kind of about my explanation that you bought 1 million naira assets and every year you are taking 100, 100, 100, 100 from it, right? You're charging 100, 100 into it, right? So when you're doing something like this, you do what you call a schedule, right? And a schedule has an opening balance and a closing balance, right? And in generally in finance, right? Your opening balance of this year should be your closing balance of last year, right? Opening balance of this year should be your closing balance of last year. So what you can do is opening balance of this year should be closing balance of year 0. Right? So opening balance of year 1 should be closing balance of year 0, right? And so forth, so on and so forth. Do you understand? That's the first thing you do. The next thing that closing balance will be the sum of everything, right? Of everything and this. So now we have our opening balance and closing balance. Do you understand? I said opening balance is closing balance of last year, right? And we highlight everything and press Ctrl R, copy it. That means for year for year for year 2 is closing balance of year 1. For year 3 is closing balance of year 2, and so forth and so on. and your closing balance, net book value, is just to sum up everything. Sum opening balance, addition, charge for the year. That's your closing balance, right? So now, the next thing is that additions, right? So now, depreciation is charged on your asset. Remember, I said you buy big assets, right? We buy a big asset, right? And we want to charge a depreciation on it, right? Pretty much recognize it slowly. So what did we buy in the year? What asset did we buy in the year? So we go to our sheet, right? Our assets we bought is the cost of the asset is 60 million. So that's our addition, right? But we not buy anything else. It's just 60 million we bought. Right? Only 60 million. Right? That's fine. The next thing we want to do is the charge for the year. Right? Charge for the year means that what proportion of this 60 million will go into our income statement. Remember, I said that's my explanation that assuming you bought a a 10 a 1 million naira 1 million naira asset, for example, but the asset will last you for 10 years. What we'll do that we will not charge 10% every year to the income statement. So what we are doing now is saying what proportion are we going to charge to the income statement, right? What portion will charge to the income statement, right? So let's go to our inputs, right? And I would like us to tell me from here we can say that our expense is 60 million, right? And the useful life is 5 million. I mean, it's 5 years, right? So what does that mean, anybody? If the useful life is 5 years, what does that mean?
Depreciating over 5 years.
5 years, right? That's it will last us for 5 years, right? So that means that, and I'm honest, I just did something very simple, so we will not overcomplicate things, right? So equals to this our depreciation, right? And we'll lock it because it does not change because that's amount divided by how many years? 5, right? That means every year for the next 5 years we charge. Sorry, every year for the next 5 years, right? We also log this as well, right? For the next 5 years, we'll charge 12 million, right? But because it's a charge, we put a negative, a minus in front of it. It's a charge. So that means every year we charge 12 million, 12 million, 12 million, 12 million until you can see in year 5, the balance is 0. Why? Because we have charged everything into the balance sheet. Do you understand? Guys, do you understand?
Okay. Yes.
It's pretty straightforward, right? There are more complex things, right? And um as one of the for coming to this class, I'm also going to be sharing my financial model template with you, my model shell, right? That's this the financial model shell I'm going to share with you is I mean it took me. Let me just give you a sneak
Sorry,
peek.
quick question. I
Right.
missed how you included the charge.
The charge, right? I said the charge is the inputs, right? I'll lock it, right? Divided by the amount of years. Yes, I also lock that as well, right?
Okay.
Right. But because it's a charge, I'll put a negative sign. But if I'm moving that, and I like that as well, right? So um, as part of what I'm going to share with you, I'm going to share with you this template, right? As part of what you guys, I mean, typically this is actually paid for, but I'm going to share. So this is a detailed financial model template that, I mean, he has everything. Like it's sometimes it may even be too detailed for you, but like he has everything linked, everything, all your workings. All you have to do in this template is just put the input sheet, and once the input is defined, everything will be done, right? Um, I mean, this template actually goes for about 20 euros, but I think I will give you guys for free or as a very stupid discount. But like, yeah, I'm going to also share this with you as well, right? So this template is a master template, but like that's for another time. Right. So as one of the followers for coming to the class, you also get that template for free. So do you understand the depreciation? Do you understand the
Yeah.
depreciation? Yes or no? Yes or no?
Yes. Yes.
Yeah. So it's
Do you
pretty
do
much
you mind
basic.
confirming how you want us to like respond to you? Do you want the muting or do you want like the interaction
I
react?
to be honest, I like the interaction because it's virtual. And I'm not saying anybody's face, just me, right? So sometimes it can feel like I'm the only one here. So hearing somebody's voice or hearing people's voice, if you're on mute, if you can mute throughout, by all means, it will help me know that okay, there's somebody at the other end of the call. Yeah.
No worries.
Thank you. So we will skip taxation and depreciation and the dividends now, because before we can get before we can get two of them, we need profit before tax, right? And we've not gotten to that point yet. So let's go to working capital, right? And now, I would like us to do some thinking, because sometimes working capital sometimes it used to get me all confused, right? But like I would like us to do some thinking around it, right? So now, working capital, right, is pretty much the money you use to trade, or or pretty much working capital means what's the capital you have available for trading, for working. That's how that's in his layman term, right? And the three elements of working capital, we have inventory, receivable, and payables, right? And this inventory, receivable, and payables, they all relate to the cash flow. And I will explain. And no, I want to explain. I will ask you guys. We do like a small exercise, right? Regarding how to treat, because most people don't know how to treat it. In fact, me say for a long time, I, w- I, I used to get confused as to how to treat it, right? I'm not sharing my screen though, right? I'm not sharing my
Yeah,
screen. I'm
yeah,
not.
you are.
Oh, I am. Okay. Now let's think about it, right? Inventory, right? Now remember, I want you guys to think about it is in relation to cash. Let me stop sharing my screen. In relation to cash. Now, inventory, inventory is what you have to sell, right? So if I'm selling this thing, if I have 50, that's what I have to sell. Now, I want you guys to think about it in relation to cash, right? In relation to cash, just cash, right? And I want somebody else that not really, I mean, Embo can answer. Right? If let's say in year one, I had 50 inventory, and in year two, I have 30 inventory. In terms of cash, what does that mean? That means that I have in year one, I had 50. In year two, I have 30. In terms of cash, what does that mean? Do I have more cash or less cash?
More cash.
More cash.
Because you sold 20.
You
Because I
should have
sold.
more cash.
Because you sold 20 and you will get cash for that 20.
Perfect, right? So that's the explanation, right? So now, if my inventory is dropping, it means that I'm selling it. That means I'm having more cash. Do you understand? So if inventory increases, inventory increases, what does that mean? If my inventory increases, what does that mean?
You have lesser cash because
Why?
you're expected to buy more inventory to have. So,
Yeah. So that means if my inventory reduces, I have more cash because I sold it. But if my inventory increases, that means I have less cash because I use cash to make the inventory. Do you understand? So when inventory increases, cash reduces. Inverse relationship. When inventory reduces, cash increases. That's one. So now let's go to the second layer of working capital, which is receivables. Receivables means debtors, right? People are owing you, right? That means your company. So for example, you sell this whatever this is called, right? You sell it, right? And somebody bought it from you, but the person not pay you, so person is your debtor, right? So if in year one, right, I have 100 debtors, or 100 euros worth of debtors, and in year two, my debtors have reduced to 60. What does that mean in terms of cash? Somebody else, 100.
You got
Yeah, continue, please.
you got in cash in, so your cash will increase.
My cash is increasing. That means that the people pretty much means that the people that are owing me have reduced.
Or
Right?
they have
That
gone
means
away, or they are run away.
okay, social. Or let's think in the positive. Let's it's not bad debt, right? But as Larry said, so that will call messy thinking. Look at all the variables. But generally speaking, right? Generally speaking, if my debtors reduce, that means people owing me have reduced. That means obviously for it to reduce, that means I've gotten the cash from them. They're no more debtors again. They're not cash. You got in the inverse, if my debtors increase, what does it mean to my cash? If my debt has now increased now, what does it mean to my cash?
The cash is
Less
reduced.
cash.
Less cash. Do you understand? It's very understandable. Now let's go to the third element of working capital, which is payables. Now, working capital just is basically looking at your how the business get cash from beginning to end, right? So payables means creditors, people that you're owing. So like let me even show you the connection. Inventory. So you buy, you want to make goods, right? So you have to buy raw materials from people, from your creditors. Like to make this kind of thing, I have to buy plastic, buy this thing. I have to buy things from people, right? So I can either pay them in cash or be a creditor to them. Say, don't worry, I'll pay you later. Payables, right? I'll pay you later. Do you understand? I'll pay you later. Then when I get my goods, that now from inventory. Then I now sell it. That's now we call receivables. Do you understand? So for payables means creditors. That means I'm owing people outside for doing things for doing things. To make my goods or to do my service or something, right? If my pay now in terms of cash, think of it in terms of cash. If my payables, that means what I'm meant to pay people has increased from year 1 to year 2. What does it mean in terms of cash for me? That mean what does it mean in terms of cash for me? What I'm meant to pay somebody. So I'm meant to let's say I was owing 100 euros year 1. Now I'm owing 150. What does it mean in terms of cash for me, for my business?
In terms of cash, you have more cash to pay,
Yes.
and you have less cash basically.
Sorry?
Less cash
So
is
you owe more.
You owe more, but in terms of the cash I have in my business, do I have more cash in my business because I owe more?
No.
E-
yes.
Yes, yes, yes,
Okay.
you have cash.
Let me
You're
let,
not
let me
paying the
explain.
cash. You're not paying
So
the cash.
it's of me to pay, like for example, I'm owing roots, right? I'm owing roots money, right? And remember, I'm doing business, I'm selling things, I'm doing stuff, right? But I'm owing roots 100 euros. I'm meant to pay 100 euros, right? But now it's up to pay 100 euros, and I even borrowed an extra 50 euros for my again. 50 euros worth of goods to sell, right? That means that I'm owing her more, means that I have more cash in my this thing, because I'm just collecting goods from her, I'm selling it, I'm making cash, making money, but I'm not giving her. Do you understand?
Okay, yeah.
Yeah. So if my payables is increasing, right, it means that I'm having more cash. But it's the other way around. If my payables reduce, right, that means if I'm owing roots 100 euros this year and 50 euros next year, that means it has reduced by 50 euros. That means I use cash to pay it because I was owing her. Yeah. So I not took cash from my business and I paid it. So the rule of thumb is, if inventory has a what do you call it again? Inverse relationship. Inverse relationship with the inverse, right? Inverse relationship with cash. Reasonable has inverse relationship with cash. Why payables has a direct relationship with cash?
I'm not
Right?
sharing, please.
Sorry. I thought I was sharing my screen. Share. Thank you so much. So inventory has a inverse relationship. That means if inventory is going up, cash is coming down, right? Receivables also has inverse relationship. If receivables is going up, cash is coming down. But payables has a direct relationship with cash. That means if payables is going up, cash also is going up, right? Do you understand? Do you understand? Yes or no?
Yeah.
Okay. Now,
Yeah.
the second thing I want to establish is what they relate to. Now, your everything I explained now, we will use that in the output session, and that's for later, right? But what I want to explain now is our how to calculate our inventory and our receivables and our payables, right? So let's come here. Yeah, they gave us receivable days, inventory days, payable days, right? And what that means, I had to be very fast. I just checked time. This is 12 after 12 already. So what that means, your inventory days, payable days, right? Means that inventory days means this is the amount of days it takes you to sell your inventory. Receivable days is this amount of days it takes you to get your money back from your client. Payable days means this amount of money it takes you to pay back your debtors, right? Do you understand? That's what it means, right? Now, to calculate inventory, right? Inventory days, right? Is inventory is if inventory relates to cost of goods sold or direct cost, right? Because you use your inventory. I mean, the way you get inventory is from cost, right? Is from like inventory is basically what you sell, which is cost, right? Receivables as well. Receivables does receivables relates to revenue or cost? Receivables does it relate to costs of doing the business or revenue of receiving the business?
Revenue.
Receivables, revenue, because receivables relate to what they are meant to get, right? It relates to revenue. Why payables relates to cost because it's what it relates to inventory or cost because payables is what you're meant to pay your suppliers to get inventory, get stuff, right? So this relates to direct cost, right? So the formula for calculating inventory is receivable, inventory is inventory days divided by total amount of days times direct cost. For receivables is receivable days divided by total amount of days times revenue. For direct payables is payable days divided by total amount of days times direct cost, right? So we'll do it in our calculation sheet. I'm trying to be a bit fast because we're out of time already. Please pardon me, we might go 15 minutes over time, right? So inventory, it will be I said inventory will be equals to inventory days. We can put in bracket anyone. If inventory days, which we have here, inventory days, right? Divided by total number of days is 365 that we have up here. We'll log this absolutely, right? Multiplied by I said inventory is based on cost of goods sold. So multiplied by direct cost. So we'll go to our calculation sheet. Multiplied by direct cost. Direct cost is up. We'll go up. Direct cost. We did direct cost initially. Yeah. Multiply by direct cost. And we'll press enter. Right. So this is our inventory days. Right. Our receivable days follow the same format. Is equals to open bracket receivable days, which is why is my cursor misbehaving now again? Where are you? Where are you? Where are you? Um, where are you? Sorry, you are here now, and you are down here. Okay, yeah. So it's receivable days, which is this 10 days, right? Divided by total number of days, right? That is up here, right? Multiplied by I said receivables is on sales, is on revenue, not on cost of goods sold, right? So multiplied by cost of goods by revenue, which is here, right? And enter, right? And we can drag it all along, right? Then for payable days, pretty much the same thing as well. Equals to open bracket payable days, which we have here, payable days, which is 30, right? Divided by number of days, that's 365 days here, lock it, and multiply by direct cost. And direct cost, we have it up here, right? So now we have our inventory days, our inventory, receivables, and payables. Do you understand? Do you understand? I believe you understand. Uh, so the next thing we'll do now is calculate our funding. And I think other funding, yeah, the last two calculations, right? The linking is much easier, right? The last calculation is source of fund and use of funds, right? Remember, I said, what are the two ways a company can get funds?
Debt and equity.
Debt and equity, basically. Debt is borrow money, equity is the owner's money. That's pretty much it, right? Sorry. Yeah. From debt and equity, right? So That is source of funds. Now, what do you use these funds to do? Right? What do you use the funds to do? Right? Use the funds to do different things, right? So the first thing you use the funds to do is to buy equipment, right? So when if we go to our input sheet, we have our um use of funds, right? So we said we'll use 60 million to buy equipment, 50 million for to do other things, then 5 million as just contingency. So our calculation is our source of funds, use of funds. We want to use 60 million for plants, for people, for assets. We want to use 15 million for working capital, right? I want to use 5% of, so we want to use 5% of of these two as contingent. So in case this, so contingent funds means that in case our PPE and our working capital, I said working capital is what you use to do stuff, right? So in case these two is not enough for us, right? We just have a contingency, right? So what I'll do that I'll do our contingent fund is 5% multiplied by the sum of these two, this plus this, right? So that just serves as a buffer, right? So our total use of funds for year one is 78 million. So that means what the business needs to start now is 78.7 million, right? And that will cover the PPE, the working capital, and contingents like salaries, any other thing. Do you understand? So that's what we need. We need 60 million to buy assets, 50 million for inventory, every other thing, and 3 million for salaries, just for the interim until start making money of their own. So the company needs 76 million, right? And where would they get this 76 million from? We have said here 20% of that 76 million will come from the company owner. 20%. Let's say Larry owns the business. Larry will drop 20%, and Larry will go and borrow 80% from the bank. So we are saying that out of the use of funds, this total source of funds, we say 80%, 20% will come from equity, and we say 80% of this amount will be for debt. That's literally that's what we're saying. And the source of funds and use of funds will be the same thing, right? So this is source of funds, and this is how you will get the funds. Do you understand? Do you understand? Financial model does not pass this, so it's literally the same thing. Different ways, different methods, different complexities, but it does not pass the same thing. Source of fund, use of fund is literally the same thing. Do you understand? Do you understand? Okay. I believe I'm trusting God that we understand, right? So now the next thing that we'll do two schedules. We'll do equity schedule and debt schedule, and that's all for calculation. We're not going to linking, right? And for linking, we will use this
So
sorry,
sorry to draw us back. Do you
no
mind
problem.
going over use of funds again?
So use of funds is what do we so pretty much the business is starting, right? And
Yeah.
we need to do certain things, right? What are things we need to do, right? Generally, use of funds usually three things. Usually, number one, plant the assets, right? So you like just take my example of you produce this thing, right? You need to buy the asset that you will need to produce this stuff, right? Assets.
Mm.
The second thing is working capital. That means you need to buy inventory, right? That means like screwdriver, this and that inventory, right? And you need
Mm.
like a portion for contingencies, right? So like some salaries in initial salaries, because yes, you make money and you start paying your staff from your salary you make, but you need at least some flexing money first to pay salaries, to pay rent, just some extra small things, right? So you need assets, working capital, and contingencies. That's what you need, right?
Yeah.
So for any business, that's it. How you calculate contingency may change, right? Maybe something else, but like we need contingency, yes. We need working capital, yes. We need asset, yes. So those are your three this thing. So what we just did is that we calculated it. So this is our assets. Yeah, our asset is our PP that we got on top. This 60
Yeah.
this thing, right? We need working capital. We estimated, we assumed, right? There are different ways to calculate, get the actual one, but we just assume that 50 million will be enough, right? The contingency is 5% of the total of two of them. That's what
Yeah.
we have as use of funds. Then source of funds, where will it come from? So we have to calculate what we need, and we will not get it from these two sources. That means the owner must bring 15.7 million, and we will not get 63 million in debt. Do you understand?
Mm.
Okay. Now, for the last thing we'll now do is equity schedule and debt schedule. That's the last thing before we go into linking equity schedule and debt schedule. And I will take a pause here to say that in March I'm doing a data analysis course. Now this financial model is more tailored towards accounting people, but data analysis course is not for everyone. And that course is 3 days. We have data preparation and data cleaning, data analysis, and data presentation. That's how to use um, Power Pivot and everything. That's data presentation. Data analysis is where we use all the formulas, every kind of formula you can think of. Data cleaning, how do you clean data? How do you import data from different sources, from databases, from different things? That will be in March. And I will send you guys the link when that's ready. And that will be a 3 day course because you can't do that one in 2 hours or this thing. It's a 3 day course, 2 hours each day. Yeah. But anyhow, when we get that which crosses, I just want to mention if I forget. Now we do a schedule. Now, who can remember what I said? To do a schedule, what's the first thing you need to do? If you can remember the schedule we did up here, the schedule we did for deposition, the schedule. What are the first 2 things you need to do in the schedule? Anybody?
Opening and closing.
Opening and closing. What's opening?
The closing of the previous year.
Previous year. Opening is closing of the previous year, right? And you drag it, right? And closing is what? Closing is just the sum of it, right? And you drag it, right? So we've already done 2 things already. As simple, we don't need too many English. Just do opening to closing. That's very straightforward, right? The next thing is equity injection. Means that so this equity schedule, that means what is coming in as equity, right? What coming equity? That's what we have up here. This 15.7. That's what's now we're doing a schedule for both equity and debt. So this 15 million is coming as equity, right? Is there any other thing coming as equity? Nothing, right? This share buyback. Let's just forget about it for now, right? That's more complex stuff, right? It's not complex, but like let's just leave it, right? So this is our schedule for equity. As simple as that. You understand? Very simple. Do your opening balance, do your closing balance, make your equity. That's all. Do you understand?
Yeah.
Now let's do the same thing for debt is a bit different, but it's pretty much the same thing, to be honest. Debt, let's do the debt schedule. So, what's the first thing you do apart from looking me or somebody else? What is the first thing you do for a debt schedule? Yeah, opening balance as well, right? So that's the previous year's own and closing balance. So that's the first thing you should do. Like, so if you do the kind of things like once 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 you have this routine, it becomes a bit more easier for you. So I said is a science. Just doing it this way, this way, this way, right? You always get it. You will not miss a bit. The next thing is addition, right? What's our addition for debt? Our addition is this 63. So no equity was 15, debt is 63, right? So that's our addition, right? The next thing is principal repayment and interest repayment. Now, when you borrow money, you don't only pay the principal. You understand? There's an interest element to it. It's not free. It's not free money. There's no money that is free money. Nothing that is free, even in Freetown, right? So we pay interest on it, right? And we pay the principal and we pay the interest, right? Principal is calculated differently, interest is calculated differently, right? So let's start with principal repayment. Now, how do you pay your principal? Let's go to our input, right? And look at our debt input. So we see that this loan might last for only 4 years, and the interest rate is 19%. That means that you will pay the principal over 4 installments, and we also pay the interest for every year we have not paid the principal in full. Do you understand? So we'll pay the interest and we'll pay the principal, right? So the principal will spread over 4 years, right? Because the tenure is 4 years, right? The principal will spread over 4 years. So one simple thing you can do is for principal, pretty much we're saying that the principal is 63 million, right? Principal is 63 million. So we want to pay this 63 million, right? Divided by 4 years, right? multiply by 4, and we'll lock it. We lock both of them. We are paying the principal in 4 years. Lock it, right? And because it's a charge, right? We put a negative in front of it, right? Because it's a charge, and we drag it across, right? Is this correct? Or what is wrong?
The interest is not there.
Yeah, no, the interest is somewhere else. So we first do principal, then we'll do interest first, right? So interest is this next line here, right? It's principal or the interest, right? But is the principal, is it correct?
Are we paying in year 0?
Yes. So no, we're paying from year 1 to from the first year every year. What is wrong with the principal? There's something wrong. Yeah, something wrong. What's wrong? How many years are we made? How many years are we made to pay the principal? How many years?
Oh yes.
4 years. But from
Total
this calculation, how many years are we paying for it?
5.
5.
5. So that means we are paying for principal when we don't even have any loan.
Yeah, even from the first year.
Yeah. Right. So it's only 4 years we need to pay, not 5 years. Right. So one way to do it is what I've taught you multiple times before, is by using a flag. Right? Using a flag. I mean, there are multiple ways. So I don't know should I use. I don't know if my time is not on my side. So I will not do. I mean, I wanted to show you how to do like a proper flag. But the easiest way to do it is to do this, right? So we know that this formula is correct, right? It's correct. The only thing is that it's doing it for more than it's doing aseju, as Yoruba will call it. It's doing it for more than the years we want it to do it for. We want to do it for only 4 years. It's doing it for 5 years. So we come here. So this formula is correct, right? But we need to just tweak it a bit, right? So this formula is correct. This thing here we have here is correct, right? But we want to just make a small adjustment to it. So we come and use if. That's why we did that warm up initially. If statement, we will use it multiple times. So tell Excel if this, right? Don't misbehave. If this, right, is less than or is greater than 4. No, it must be only 4 years, right? So if this is greater than our tenure, which is 4 years, right? If greater than our tenure, right? Give us 0. If not, give us a calculation. So what told Excel is that Excel, every time, like, you know, the loan is meant to last for 4 years, right? So we just told Excel, if this, you know, this year 1, year 2, year 3, year 4. So if you pass 4, our tenure, this thing, just don't calculate it again, give me 0. If otherwise, calculate it. So when we do this, you can see that year 4 has disappeared. I mean, year 5 has disappeared because it's nothing happened in year 5. We're not paying in year 5. We're only paying in 4 years. Do you understand?
I have a question.
Go ahead, please.
Are we doing this based on the assumption that we're repaying the principal in the same year we got the loan? Because
Yes.
okay.
Yes. So that's I'm using a bit. So now the assumption can be different. I mean, can differ. They say, oh, pay it only from, or start paying from year 2, year 3, year 4. Yes, sir. It all determines. It all depends on the assumption you give us, right? But me, I'm using a very basic assumption that let's just start paying it from the year 1 and year to year 4. Right? That's just the assumption. Yeah.
Shouldn't be a reducing balance too.
What you say?
Shouldn't it be a reducing balance?
We didn't balance. Like we pay. So this is the principal, right? We are paying the principal. Is the interest that is the reducing balance? Do you understand? Is the reducing balance is on the interest. That is, so we pay the interest on what is left, right? But the principal, you have to pay the 63K. So this is just principal repayments, not interest yet. Do you understand?
Yes. Thank you.
Yeah. So what we have done now is just the principal repayment, not interest. The interest is that's what we're going to do in this next line, right? So now this is our principal repayment, but now our interest, they say that we pay interest 19%, right? From input, if you check the input sheet, you see that our interest is 19%, right? So every year, right, we pay 90% on, 90%, right? On the opening balance, 90% of the opening balance, right? So what we'll do is that um what we're paying interest on is is 90% of what is left, right, at the beginning of the year, right? 90% is of what is left at the beginning of the year. 90% of what is left at the beginning of the year. So that means that for year one, right, what we're paying for is 90% of the opening balance. But the opening balance as at year one is zero. So what we're paying interest on is on the actual addition. But in year two, what we're paying on is on the opening balance on year two. In year three, what we're paying on is on the opening balance in year three. In year four, what we're paying on is on the opening balance in year four, right? So what we're paying on is on this, right? But for year one, what we're paying for is on this, right? So year one, we're paying on the addition on the full amount because initially there was nothing there. But for other years, we're paying on the closing balance. On the opening balance of that year, right? So one way to achieve this, right, and to have one formula to do everything is to use the max. Remember in our Excel warm up warm up stuff, I taught us to use max and min, maximum value and minimum value. So what we'll tell Excel is that Excel, give me the maximum value between this and this, right? So you can see that the maximum value here is this addition, while the maximum value for this one is this opening balance. You understand, right? So this is the basis at which we pay our interest rate, our interest, right? Then our interest is 90%, right? So we just multiply this by our interest rate, our interest, which is 19%, right? And we'll lock it, right? 90%, it will not change. So we lock this, right? And we move it like this. So this is the interest we're paying. Year one, paying 11.9% interest. Year two, 8.9% interest. Year three, 5.9% interest. Year four, 2.9% interest. Do you understand? Do you understand?
Yeah.
Okay. So now that we are done with calculation, remember there are two calculations we did not do. We did not do the tax and dividend because we need to calculate profit before tax. Now that we are done with this, right? The next thing to do is to now link it to our output sheet, right? This is our output sheet here. Sorry. This is our output sheet here, right? The next thing we want to do is to link it to our output sheet. But now, this is where you need to be very. Now, I'll leave us to do it, right? I'll be doing some. I'll give her the steps and I'll ask us to do it. I'll give her the steps, ask us to do it. Give her the steps, ask us to do it, right? So, let me bring in the steps. I will copy the steps. Now, the thing about linking that if you use the steps I'm going to share, right? Everything will balance, like you'll be well. But if you try and do it on vibes, you most likely make a mistake, right? But if you do it on like following this format, right? This exact format I'm sharing on the screen now, right? Everything will work out well. So the first thing that it asks us to do, what's the first thing in our step? Link revenue, direct costs, and indirect costs. So can we all link revenue, direct costs, and indirect costs? So pretty much, we've already calculated everything here. Now, we're not doing any calculation again. We are just linking, right? So now, link revenue. So revenue is equals to revenue here. Revenue is here, right? Link revenue. Bam. The next thing is what? Link what? Direct cost. We have calculated. All we're doing is linking direct cost. Direct cost is negative, is in the cost, so we'll do negative minus. Direct cost is here, right? This is direct cost, right? He has given us that. And next thing, so we should link what? Link indirect cost. That means these other expenses, right? So link salaries, admin, and operating expense. Can we link it? Can we link it? And I want you to tell me what the EBITDA is in year five. So link these three and tell me what the EBITDA is in year five. It's very simple. Just equals to minus because it's a cost, right? So salaries, we've already calculated everything already. So we're just linking it, right? Administrative costs as well. We've done that, right? We're just linking it. Admin cost is here, right? And other costs, other expenses, we've done that already. That is what is here, right? And we link it and drag it, right? Have we gone to this area?
Is the EBITDA 1.1 million and 14,000?
Oh no, I have
No,
135
no,
something.
no. No.
No,
EBITDA.
the figure may change if we use different exchange rate or different something, like maybe I use something, I use something else. But like as long as everything is well, like that's fine. Do you understand? So the next step, right? The next step in this, right? You can see that the next step is not, normally some people will go and do depreciation. No, don't do depreciation, right? That's not the next step, right? You just like we you can do it, but most of them are not. You might miss something. You might miss something and miss something. So the best thing is not to do it at the moment, right? So the next thing to do is link income statement to income statement profit before tax. Sorry, let me make it profit before tax. Let me make it to cash flow profit before tax. So we want to link so we want to link the income statement to the cash flow, right? So after we have done this thing, next thing we'll do is this cash flow statement, right? What to do? I want to link this income statement to the cash flow by linking this profit before tax. So we'll come here, equals to what is our profit before tax, which is here, right? Link it here, right? And drag it here. That's all, right? Profit before tax. Have we all done that? So just follow these steps, right? If you follow like you, some may say, "Oh, do everything." You come, no. Do it step by step, and that's when you get like that your model will always balance. Are we together?
Yeah.
Okay. The next thing in our this thing is link positive cash in cash flow to balance sheet using Marx formula. Link negative cash in cash flow to balance sheet using negative mean formula. I will explain this. So the first thing we did was that we did the income statement. We did a major part of the income statement. The next thing is that we did was to link this income statement to cash flow, right? Now the first thing we want to do is that we want to link this cash flow to balance sheet, right? So we link income statement to balance cash flow, right? And the next one is cash flow to balance sheet, right? Now, what they're asking us to do is to link the cash. So now, if how many of you as your balance in your account gone to negative? Has anybody balance in your normal bank account go to negative before? Anybody? It's not just asking, right? But like, I mean, when your account is in negative, right? When your cash is in negative, that means you have an overdraft. That's what it means, right? That means it's almost like the bank is giving you like a soft loan to use. Then you have to pay it back, right? But when it's positive, that means you have a good cash, right? So what we'll do, right? All we are doing is that we now want to link this our cash at the end of the year. So what's that? If this cash is positive, it should come to cash here. If it's negative, it should go to overdraft. If cash is positive, come here. If cash is negative, go to overdraft. And the instruction says use Marx formula for positive cash, use mean formula for negative cash. All we do is very simple, right? In our cash, we'll do equals to max. That means give me the maximum of the cash at hand and 0. Right? So give me the cash at hand and 0. For overdraft, what we'll do is minimum of this and 0. These are 0. So let me just test one. So because this is positive, that's why you are seeing it in cash, right? But if it's negative, let's say I change it to minus 90, you can see that it moves from cash to overdraft. Do you understand? So if it's positive, it stays in cash. If negative, it goes to overdraft. Do you understand? Do you understand?
Yeah.
Our energy is dropping.
No, but I guess that's like is it equal to check you imputed in the model?
Yes.
Okay.
Right. And you can see that our model is not still balancing, right? Because we have not finished the steps. The next thing is that we need to link closing retained earnings on income statement to retained earnings on balance sheet. Closing retained earnings on income statement to retained earnings on balance sheet. So we have linked income statement to cash flow. We have linked cash flow to balance sheet. Now we want to link income statement to cash flow. I mean to balance sheet, right? So we've linked income statement to cash flow. We link cash flow to balance sheet. So the final one is to link income statement to balance sheet. And what did he say? Link closing link the retained earnings on income statement to retained earnings on balance sheet. So what we'll do is come to retained earnings on balance sheet is here, right? So equals to, we will now pick it from the retained earnings on income statement, which is here. We'll link it together. And you can see that your model now balances. So with this, your model has balance, right? Now we have a working model, because what makes a working model is that your income statement links with your balance sheet. I mean, your balance sheet and cash flow. Your cash flow links with your income statement and balance sheet. Your balance sheet links with your income statement and cash flow. Pretty much, it means that every statement links to themselves. Are we all together, right? It's just literally following this on a step-by-step basis, following this one by one, one by one, one by one, one by one, one by one. Now, the next thing is to do depreciation, right? Depreciation. Now, to do depreciation, there are 4 steps. You put the addition in cash flow, you put depreciation in income statement, you put net book value in balance sheet, and you add back depreciation in cash flow. So these are the 4 steps you will use. So the first thing says that addition should go to cash flow statement. So you go to cash flow statement, right? Addition, right? So addition you go to cash flow statement. So yeah, so equals to, you go to your calculation, right? Where's your assets? Your asset schedule. I think we have it here. So additions here, we go to cash flow. So addition goes to cash flow, right? That's step 1. Step 2, your depreciation should go to income statement. So you go to your income statement, depreciation here. So depreciation go to income statement. So go to here and go to our calculation. Where depreciation is here, charge for the year, right? It goes to our income statement. It enters here. That's number 2. You see that our balance sheet is not balancing, right? Because we've not done all these steps. Number 3 is book value. Book value should go to balance sheet. Net book value should go to balance sheet. So go to balance sheet now. This balance sheet is there, or statement of financial position. Your net book value should go to this place. So equals to, you go to calculation sheet. Your net book value, which is closing net book value, comes here, right? Comes here, right, to your balance sheet, right? You can see that it's not still balancing because we have not finished all the steps, right? The steps is add back depreciation in your cash flow, right? So we now come to cash flow, depreciation here, right? And we add back depreciation, right? So depreciation here, our depreciation is here, is 12, right? But because we're adding it back, we remove the negative, right? And we add it back, right? Let's add it back. Yeah, remove the negative, right? When you do this, right? Are we together? Sorry, I hope I'm not talking to myself.
No, we're
We are
together.
together.
Okay. So I said the first thing you do is to take the depreciation, right? Sorry, not depreciation. You brought an asset, you add it in cash flow statement, right? Which you have done here in cash flow statement. You bought asset of 60 million, right? Cash flow statement. Next thing you do is you are depreciating the asset every year, right? And depreciation should go into your cash flow statement, which what we have done here, right? Cash flow statement. So every year you are depreciating for 5 years, right? The next thing that the step asks us to do is to take the book value in the balance sheet, right? Book value of the asset in balance sheet. That means the remaining balance of the asset in balance sheet. What we have done here, right? So we are putting the book value of the asset, right, in the balance sheet. Sorry, let me answer this first. So we have put the book value of the asset in the balance sheet. Then the next thing it's asking us to do is now to add back the depreciation in the working capital bit. So this, our depreciation, we're adding it back. So our job is 12 here. We'll add it back. minus, yeah, we add back depreciation. Right. The next thing we're going to do now is now interest, right? For interest, these are the steps. The first step, you take a loan. So in the cash flow statement, you took a loan, you repay the loan, you pay the interest, you pay the principal, and then the book value now goes to balance sheet, right? So first thing, you take a loan. So all the addition goes to the cash flow statement. So that addition of the loan. So the first thing is the loan you took, right? So which is here, financing activities, right? You took a loan, right? That is loan, right? Loan, proceeds from loan, right? So you took the loan. So the loan will be what you took. Well, that's your debt schedule, right? That's final thing here, right? You took a loan, right, of 63 million, right? That's 63 million. Are we together? Guys, are we together?
Yeah.
Okay. So we took a loan, right? When we took a loan, is money. Remember, this cash flow statement is you have to think about it in terms of cash. When we took a loan, right? Took a loan from the bank, right? Are we increasing our cash or reducing our cash? When we took a loan,
By increasing our cash.
increasing our cash, so it will be positive. Just the second thing they put there is now you we're making repayment of the principal. When we're making repayment, is it increasing our cash or reducing our cash?
Reducing the cash.
Reducing our cash because we are making repayment. So when we come here and do our repayment of our principal, it's reducing our cash. So it will be negative, right? We come here, this is our principal repayments. So it's already negative already, so it's fine, right? Principal repayment is negative, right? That's our principal repayment. The next thing we're doing is payment of interest. Payment of interest goes into two places, into our cash flow statement and goes into our income statement. Now, for repayment, repaying interest, is it a for our cash flow? Is it increasing our cash or reducing our cash?
Reducing.
It's reducing our cash, right? Because we're making the payment. So interest payment from a calculation, which is this, right? But if we reduce our cash, so we have to do it in negative. It's reducing our cash, right? So we have done it in cash flow. We need to also do it in our income statement, which is here. Income statement, our interest part, right? Interest also is negative income statement. Yeah, right? So we have done that. The final one or the last two said the book value or the balance needs to go to balance sheet. So balance sheet basically takes the balance. Balance sheet takes the balance. So go to our balance sheet, right? The balance sheet, right? And we have a debt, a long-term debt, and it comes to here, right? So the balance of our debt comes to our balance sheet. This is our balance here, right? Balance comes to balance sheet, right? Then the final thing that we need to do, right? That see, it's not balancing yet. The final thing we need to add back our depreciation, our interest in our cash flow statement because we're counting it. So we go to our cash flow statement and add back our interest element. The interest element is here. We add it back, right? And you can see that our balance sheet is balancing. So for every step, is making sure we balance. Everything we are doing, make sure we balance, right? So now we have done depreciation and it's balancing. We've done interest, is balancing. The next few things to do is tax, dividend, shares, and working capital, and everything will balance, right? We first start with tax, right? Tax. So we have to do taxation, right, for the year, right? But if you remember, tax and dividend in our workings, I'd also leave our tax and dividend empty, right? So for tax and dividend, the way you pay tax on the profit, right? So equals to your profit, right? Which is your profit before tax here, right? So that's our profit, right? Then what's our tax? Our tax here is from our this thing, our tax is 32%, right? So what we do is equals to profit before tax times 32%, right? 32%. We'll lock it, right? So this is all the tax we pay every year. That's what we do. Then, so we have done our calculation for tax. The next thing now to do is now to do the taxation in income statement and cash flow. So first, income statement. Income statement. Our tax is what? This is our tax year that we calculated, right? But it will be negative. Remember, tax is negative, right? So negative. I mean, tax is reducing your profit, right? So tax is in your profit. So we are putting tax in our income statement. The next thing we should put tax is our cash flow statement. So cash flow, right? Tax paid, right? We have to put our tax. So when we're paying tax, is money coming in or going out?
Going out.
Going out, right? So that will be negative, right? Negative for tax, right? Negative for tax, right? So now we have done tax, and you can see everything balances, right? So just it's the thing that is following this step by step by step process, right? Step by step by step by step process that makes it worth it, right? The next thing in our this thing is what? Dividend, right? So we go to dividend, right? Dividend is income statement, right? Dividend. I said we in our calculation we left a space for dividend. Dividend is calculated on profit after tax. So first thing is to call our profit after tax from here. Profit after tax, which is this, right? This is our profit after tax. The next thing now is to now do the dividend, right? And what's our so what does dividend mean? Anybody want to explain what dividend mean? Dividend.
Dividend is basically your returns on investment, kind of.
Yeah, pretty much, right? Pretty much your return on your investment, right? So your dividend, your dividend is sorry, calculation is we said our dividend will be for year one, right? We'll pay out 0%. Year two, we'll pay out 20%. Year three, 20%. Year four, 20%. That means our dividend, right? Means in year one, we're not paying out anything. So times 0% year. But in year two, so it's pretty much from our profit. How much are we paying our um equity investors, right? That we're trying to calculate. So in year one, we will give our equity investors 14 million. In year two, we give them 15 million. Year three, so that means this amount of money they're making from the initial investment in the company, right? This dividend payout. That's what they enjoy. And dividend is a good business because if you can remember from our calculation, our equity is only 15 million. That means they only gave 15 million. But like first year, they're getting 14 million. They're getting a lot of money. They're big boys. And yeah, this is not a real business, so it's not obviously not real. Okay, so now dividend, right? So I said dividend, dividend we read in tax in um income statement and cash flow, right? So we'll go to income statement first. Income statement, dividend. Dividend is we are paying the money out, so it's minus, right? Dividend, what is dividend? Dividends, yeah, this is our dividend. Year one, we're not paying anything, right? But from year two, year three, year four, we are paying. You understand? So we have done dividend in income statement, right? Now we do dividend in um dividend in what again in cash flow. Now dividend, when we're paying dividend, is money coming or going out for cash flow?
Going out.
Going out, so it's negative, right? So
Yeah.
dividend, yeah, for dividend is here, right? And this, right? You can see that the check is okay. And if you check up here, there's something I put here, balance sheet okay or not. So if not balancing, that means you show error, right? But if balancing, you show okay. That's another way to check. Yeah, okay, right? So we're almost done in with mapping everything out. The last two is share capital and working capital. Working capital, I've already explained it already, so I'll just do it because I've explained it already. So for share capital, we need to do it in cash flow and balance, right? So share capital, let's go to cash flow, right? Cash flow, that's here, right? So share capital, the inflow goes to cash flow statement. Share capital means the amount of money that was invested in the business, the equity, right? So the amount of money that was invested in the business is money coming in or going out. For share capital, the amount of money invested in the business is money coming in or going out. The share capital, that's the equity
Coming in.
coming in, right? So that's equity injection, right? So this amount of money is coming in, right? So it's positive, right? So the next part of it is the next part of it from our this thing is the balance goes to balance sheet. So But we'll go to our balance sheet, right? Balance sheet. Balance sheet, that is where you go, where you see share capital, right? So the balance of it comes here. Balance of it, that's the closing balance here, comes here. And you can see everything balances, right? So the final thing, so like, so if you follow this method, your balance sheet, you always have, because now you're not doing science. You're not doing art. You're doing science. You're taking it one by one systematically. Because if you try and do it haphazardly, you might forget to maybe remove tax here, remove this thing here. But like if you follow this, it's like it's almost like a sure way to ensure that everything will go systematically. The final one is now working capital. You must do the balance will go into balance sheet, the changes will go into cash flow statement, right? So balance will go to balance sheet. So let's go to balance sheet first. Of the working capital. Working capital for balance sheet, right? We have inventory, receivables, and payables. So inventory first, right? Inventory first. So inventory will come here. Inventory calculation. We have our inventory here. Inventory here, right? Inventory. We have our receivables. Just pick it from receivables here as well. Receivables here. Link everything up together. And we have payables. Payables is down here. Payables from here, right? And you link everything down here, right? But you see, it's showing error. That means it's not balancing. There's something we need to do, right? We are not finished. The last step is changes in cash flow. Work capital change in cash flow. Then we'll come up here. These last three, change the working capital. So these three things we need to do, right? These three things we need to do, right? And now this is where what I explained to you, that inverse relationship or debt relationship matters here, right? So now your inventory, right? If your inventory is going up, is cash coming in or going out?
Going out.
Going out, right? So now so remember I said if inventory is going up, right? Um, 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 inventory is directly inverse relationship. Sorry, if inventory is going up, that means cash is coming down. That means you are using more money to buy the goods, right? So it's an inverse relationship. So what we're doing here is changes in working capital. So change in working capital means, see, this is our inventory in the beginning. Let's go to the calculation, right? So this is our inventory in the beginning. This for year one, right? For year one, let me bring this somewhere else. Let me bring it somewhere else. Yeah, let me bring it here. So for year one, right? For year one, we assume this is 0, 0, 0, right? So for year one, inventory was 0 in year 0 and it's not 18 million in year 1. The inventory go up or go down? I mean, the cash go up or go down? From 0 to this thing. Inventory is increasing. Is cash going up or going down?
Going down.
It's going down. Remember, inventory is inverse, right? Inverse. So what we do here in our output here is year 0 minus this, right? So because our this just means that our inventory went up by 18.9. But in terms of cash, it means cash went down by 18.9. Do you understand? The same thing for receivables. Receivables, if our receivables is 0 and 0 in year 0, 0 in year 1, and 11.3 in year 0 in year 0 and 11.3 in year 1. Our receivables went up. That means people owing us went up, right? Does that mean that we have more cash or less cash?
Less cash.
Are you sure?
People owing us went up.
Yeah.
We don't have them in our hand, no? Except I'm mixing it up.
No, it's correct. I'm just saying to, get. I mean, so it's not just be like going up, right? Because this is also inverse relationship. So that means our inventory was 0 before, and now is now 11 point this thing, right? That means our cash has reduced because we have many people owing us, pay up. Now the final one is payables. Now payables was 0 in year 0 and now it's 20 million. It has increased. Do you have more cash or less cash?
Payables, yeah, more cash because we haven't paid them.
Do you understand? So payables is different, right? The payables means that because it's increasing, right? That means we're not paying people. we are holding the money for ourselves. It's increasing, we're holding money for ourselves. That means for payables, it will not be old minus new, with new minus old, because now the increase means the increase in payables also means an increase in cash, right? So it will not be this minus this. Do you understand? So we will now drag everything across board, and you can see that your balance, everything is okay now, right? So this is a 3 model statement, and I've already linked the cash distance, so you can see everything is ready. You have your trend, you have your ratios. I mean, all these were pre-calculated already because I know we don't have time, right? So everything is ready. But what really matters the most is you following this step by step by step by step process. Do you understand? Following the step by step by step process. Do we understand?
Thank you so much, Prof.
Mhm.
Okay,
And
thank you
then
so
I
much.
really do appreciate the way you analyze the working capital changes, because to be honest, I used to struggle with that. But this perspective, I think is going to stick with me. So thank you so much for that.
Okay. So yeah, so pretty much that's the base of financial modeling. It will not pass this, right? I mean, I can show you, I don't know if I can show you, but maybe if I stop recording, I can show you. I can show you more complex model I've done. But at the end of the day, the offer, if you can follow these steps one by one by one. But remember, this, like, most of us might not necessarily do this step by step Excel thing, right? If you're not really working in finance, right? But at least you understand how to do MISI, understanding the drivers. That's, to me, I think that's the most important thing, right? And that's the value add you bring, not this this, if you give ChatGPT or Copilot, right? They may be able to do a good job if you tell them what to do. If you help you and do the whole linking and but it cannot, remove you as the driver. Understanding the business, knowing what, right? They're looking at it and interpreting it, right? That's what your value add is in, right? It's not just the technicality of it, the modality of it that we spend 1 hour 30 minutes doing, right? But it's actually the understanding of the concept, the frameworks, right? Understanding MISI, understanding how to drive, right? And knowing the kind of questions to ask, right? To get the right answers, right? I remember that financial model is a science, is the art, that's the assumption part, but also a science. Science is actually what I just told you about, following it from this like this step by step process I've done. You will never just follow it one by, you will never go wrong. One by one by one, you will never go wrong. Can there be complexity? To be honest, the complexity really comes in depreciation. Maybe you have I did it very simple because we have just one asset. If you have multiple assets, it's the same thing. You just do it for all the assets, multiple assets. So you have multiple depreciation schedule. I assume we have only one loan. If you have multiple loans, you just do the loan schedule I did once, just do it multiple times. It's literally the same thing. There's no difference, right? Those that are advanced just know how to do the simple things very well, very well, very well. And I said your model is not about multiple formulas, it's about just doing those simple things very consistently. So after this call, in a few minutes, I will share with you the passwords again. Just you can totally unlock it, right? So you don't have that password issue. I'll share the password. I'll share with you the model driver document logbook I have. So any model you're doing, just pick out the logbook. It will give you everything you need to know. And just okay, I need to then yeah, it will give you all of that. Number two. Number three, I'm going to share with you the Excel um model template that you can use for anything, right? It's very advanced, it's very technical. I will also share that. And number four is that I will share with you a link to this course, this training, right? You're going to be on YouTube, but it's going to be unlisted. So unless you have the link, you will not be able to access it, right? So it's on YouTube, but it will not, unless you have the link, you can access it. So the link, it will not be in public domain. Only those that have the link, right? And for everybody that attended this course, right? Between now, I mean, throughout the month of February, right? I'm going to give you guys 30 minutes one-on-one session, right? In case you have any question to ask, maybe you know understand something, you want to have just get to my this thing, take 30 minutes. We can fix a time that is convenient for both of us, right? Have 30 minutes and just answer any question you may have, any like anything, right? So everybody has 30 minutes with me, right? So apart from these 3 hours, I've gone over because we use 3 hours, not 2 hours. Apart from these 3 hours, and additional 30 minutes, right? Like I sit down with me one on one, right? There's no other person here, me and you on the call. and oh, I don't understand this thing. Can you run through these things? And that's all for free. Do you understand? Like, thank you guys so much. Don't forget I said in March I'm having a data analysis boot camp. Is 3 days. I'm supposed to just 3 days of 2 hours each. Financial and this one is for everybody. Now this is not just finance. This is not finance people. This is not financial related, right? So how to get data, right? Clean the data using multiple techniques, right? How to analyze the data, right? We're going to XLOOKUP, going to pivot table, advanced pivot table. We're going to all the various linking and everything. Then how to present the data. I hope it has been a valuable class for you. And finally, I want to send a link to a feedback form. I really love feedback. I really like detailed feedback. Just as many what you enjoy, what you don't enjoy, what we can improve on next time. Please, 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 please let me. What you paid, I really appreciate, but to be honest, the payment was actually just for commitment. So for the past 7 years, I've been doing this training for free, like every single year. Like last year, I did 31 days Excel class for free. So the payment was just to make sure that people that come for the class are a bit serious. To be honest, like 10 years was just to make sure that people that are coming to class, there's a commitment to it. Like, I'm committed to it, right? So thank you guys so much, and I will see you in the next in the absence of any question. Thank you so much. Please make sure you fill the feedback form and expect to hear from me before the end of the day. God bless you
Thank
and
you so
have
much.
a
Goodbye.
wonderful,
Thank
wonderful
you.
day.
See you much. See you much.
Bye.
Bye.
Bye.